Good morning from Tokyo. Welcome to the ADBI virtual conference on financial technology, climate change, and the challenges for central banks and financial regulators in Asia. ADBI is the Tokyo-based think tank of the Asian Development Bank and aims at bridging research and policy making for the benefit of ADB's developing member countries. Today's conference discusses two broad sets of important issues relevant to central banking and financial regulation. The first concerns the digitalization of financial services and digital transformation in the financial sector and beyond. New financial services such as mobile payment, credit scoring, loan based on credit score, and AI-based financial advice have become available to consumers, and these services are provided by combinations of enterprises in different sectors. Some people use the term trust revolution to emphasize profound impacts of reduction in transaction costs due to digitalization on the society. But of course, technological disruption tends to create social disruption. The digitalization of financial services is not an exception. The new challenges that it has invited included data privacy, infringement, and massive entrance of new businesses outside financial regulation into the financial sector. Central banking is also being affected by the progress of digital technology. Many central banks are examining the impact of the rise of private digital money and explore the feasibility and impact of issuing CBDC, central bank digital currency. The first session of the conference will be devoted to these policy challenges. There will be a few presentations by distinguished professors, which will be followed by a high panel discussion by practitioners. The second session tackles another set of very important issues, namely the challenges accompanying the promotion of climate finance, especially climate-related information disclosure and supervisory approaches. Fostering climate finance must be essential for achieving carbon neutrality in the world. To build trust among investors, greenwashing must be minimized, and transparency in information disclosure must be strengthened. Various tools are being developed to assess climate actions and broader environmental actions, and to increase traceability and transparency, even though the development is still in its nascent stage. We do not know whether those approaches and tools good for developed countries are also good to developing countries in Asia and the Pacific. There seems to be a lot of arguments worth careful consideration. The second session will have a presentation by distinguished professors and policymakers, which will be followed by a high-level panel discussion. The third and final session will be a panel discussion by central bankers. A focus of the discussion may be placed on the recent banking sector tensions in the United States and Europe, which was triggered by a rapid deposit run through dissemination of information across social media platforms and the near real-time ability to withdraw funds electronically. The panel would also share views and experiences on digital money, central bank digital currency, and climate issues. Finally, I would like to thank all the speakers and participants for their taking time to join this conference on these big challenges in monetary and financial policy designs. I hope the discussion by researchers and policymakers, practitioners, will contribute to evidence-based policy and policy-based research. I wish you a very fruitful exchange of views and opinions. Thank you very much.
I think these opening remarks very well set the scene for the rest of the event. We can now begin with session one, which will last for 1 hour, 45 minutes. We will have 3 main presenters who will speak for 20 minutes each. This will be followed by 2 discussants who will speak for 10 or 15 minutes each. And then at the end, we will have a Q&A session which will be open to all attendees at this event. For attendees, please enter a question that you may have either in the Q&A box or in the chat, and we will pick it up at a later stage at the Q&A session. The first speaker today is Charles Kahn, who's Professor Emeritus at the Department of Finance and the Department of Economics at the University of Illinois, and he will be speaking on digital money and central bank operations. Professor Kahn, please go ahead.
Thank you. Then I can start. Thank you, first of all, for including me in this conference. The advances we are seeing now in the digitalization of payment systems pose important and fascinating challenges for central bankers. The issues are really too broad for a whole conference, much less a single session. But what I would like to do is make some points about the operational priorities for central bankers when considering digital retail payment. Why retail digital currencies? Why is the interest in them? I believe that can be divided into 3 categories. First of all, digital currencies offer the possibilities of improved payment system functionality, allowing faster, more seamless, more reliable payments without the need for physical proximity, and with the possibilities of added features not currently available, such as programmability and protections against loss. Secondly, in many countries, access to the full benefits of modern financial systems is restricted for those who are limited to the cash economy. Digitalization of money opens the possibility for increased participation and therefore spurs to economic growth. And finally, particularly of interest to central banks as the custodians of the monetary system should also be concerned by the possibility that if they do not keep track of and maintain supervision of the system, they might become irrelevant. Private institutions, either domestic or abroad, might step in and provide these payment services, weakening the central bank's link to the monetary and payment systems, and ultimately weakening the monetary autonomy of the country. I think that central banks, in fact, first began to take this question seriously when Facebook launched its Libra project in 2018. That spurred an intense interest among central banks in the development of central bank digital currencies. And although Libra and its successor Diem have disappeared, the concerns remain real. After all, CBDC is not the sole possible route to a further digitalization of the payment system. What are the forms that digitalization can take? Besides CBDC, private arrangements continue to grow. Stable coins, cryptocurrencies with values pegged to a reference asset, such as a national currency, may currently be under the cloud. But other private digital arrangements, such as mobile payments innovations, continue to grow and continue to have plenty of room for further growth. And there is a third route. Even if the payment system continues to be dominated by banks, sticking with existing account structure, digitalization of payments can be spurred by the development of interbank infrastructure, allowing for faster payments. And these improved infrastructures can occur either through the organization of a central bank, or they can be promoted by a subgroup of banks in the country seeking a strategic advantage. With all of these possibilities in play, what are the concerns? Where should central banks focus their attention? Naturally, central banks are concerned about the effects of digitization on the transmission of monetary policy. How will households' demands for and use of money alter central banks' power to affect interest rates and control inflation? But they'll also be concerned with the effects on financial stability, in particular, whether banks might become unstable because of increased risks to their liquidity. Thirdly, central banks which have a mandate to maintain the payment system will also be concerned with risks to payments infrastructures, particularly when non-bank payment systems are systemically important. But as I'll argue later, these concerns are even relevant whether or not the central bank has an official payments mandate. And finally, as I mentioned before, central banks have an understandable concern with their own continued relevance. Specific examples of this concern, which may be relevant in particular countries, are such things as, does the development of a payment system does the development of digital payments affect the ability of a bank to collect its seigniorage? Does it increase the threat of dollarization? While we can tell good stories as to why all of these concerns should arise, it's not easy to evaluate the actual importance of them, given the relatively short history of, for example, CBDC. But these concerns aren't new. So some insights might be gathered from the examination of earlier innovations in the payments arena, in the course of which similar concerns have arisen. Now, three examples might be of particular relevance for this. First of all, the mobile payments revolution has been going on for long enough that we can begin, possibly, to determine the magnitude of its effects on national economies. M-Pesa, in particular, has been the subject of study by both development economists and payment economists, although the time series is still too short to draw the very confident conclusions out of it. But earlier payments innovations may provide stronger implications. For example, the move to card-based payments in many countries was every bit as revolutionary a step as the current payments revolutions, and it may allow us to see effects playing out over a longer horizon. And finally, even payments innovations which might not normally be classified as digitalization may give useful information. An example of this is the introduction of automated teller machines for easy withdrawals of cash. These began to appear in the 1960s, and so could also be part of a long-run change in payments behavior. If we look at mature economies, we see that indeed there has been, over the long run, a marked decline in the currency and circulation in these economies relative to GDP. The table that I'm showing you here is from an article by Zhang and Xiao out of the Bank of Canada and published in the Review of Economic Dynamics. You can see, interestingly enough, something that they point out, which is that the long-run decline in the currency relative to GDP in many of these countries has seemed to slow down or even reverse just as the latest of the payments innovations have been rolled out. And those two authors call this the cash paradox. In a working paper at the IMF, Lukanga also shows a similar picture for a more varied set of countries. In fact, one of the few countries to show a long-run trend against cash, it's a long-run trend of reducing cash usage, is Sweden. In fact, the long-run trend against cash in Sweden was probably an important contributor to that country's central bank's early interest in the study of CBDCs. But in general, it's apparent that payments innovation is not the only determinant of cash holdings. In shorter runs, other considerations, financial crises, pandemics, interest rates, are powerful enough to deflect any long-term trend in cash usage. So, what are the effects? What are the effects of previous payments innovations on monetary policy? Lukanga argues that while long-run payments developments may have rendered M1 velocity more unstable, broader monetary aggregates have been less affected. In any event, I would argue that the changes that have occurred slowly enough that central banks have adapted their policies without conscious effort. Although there has been speculation that over the long run, these innovations have led central banks to reduce their focus on monetary policy. Now, I described three possible routes to increase digitalization at the outset. Of the three, CBDC would be expected to be the one that has the biggest effect on monetary policy, because CBDC would be automatically a component of the money supply. But so far, CBDC has not taken off in the way that the other two possibilities, non-bank payments and faster payments, have taken off. I believe that at last count, only 4 CBDCs are up and running, and the uptake in those CBDCs has not been spectacular. In the Bahamas, 2 years after the launch, CBDC is less than 0.1% of the currency in circulation. Now, that's not to say CBDC might not become systemically important at some point in the future. But the acceptance contrasts sharply with private payments developments and with developments in infrastructure. For example, contrast the slow uptake of the extensive pilot program for CBDC in China with the phenomenal growth of its mobile payment systems, notably WeChat and Alipay. And China is indeed one of the countries with the fastest decline in currency in circulation, although this decline began well before the introduction of these mobile systems. Now, the clearest link between changes in money demand and development of private payment systems is probably in Kenya. M-Pesa's commercial launch was in 2007, and by 2012, there were 17 million accounts in a country of 44 million population. This here in this picture is a close-up of the currency per GDP line for Kenya. And you can see that the trend of currency per GDP dramatically reversed with concomitant with M-Pesa's growth. As for the third possibility, faster payments, Brazil's PIX system is the poster child for the dramatic results. In less than 3 years since its launch, it has grown astronomically, with 100 million users and monthly volumes of trillions of reais. This graph compares transactions in PIX with other retail payments media. It is a little out of date by now, because by now PIX has grown to 3 billion transactions per month, reportedly almost 5 times greater than those for debit and credit cards combined. The time period, though, is too short to be able to sort out any of the effects of PIX on the monetary system, separate from the great number of other economic disruptions of the past couple of years. But the data certainly indicates these innovations may be the crucial ones to watch for real changes in the retail payments landscape. Well, if in fact CBDCs turn out not to be where the action is in the digitalization of payments, does that mean that central banks have reduced concerns about dealing with these changes to the payment system? Emphatically not. Almost all of the complications that could arise for a central bank are independent of the form that the digitalization takes. For example, improvements in retail payment systems inherently entail a loss of subsidies to commercial banks. Payments accounts at banks earn lower than market interest rates. Account holders are willing to accept this difference in return for the liquidity that the accounts provide, which essentially means that in return for the usefulness of those accounts as transactions vehicles. CBDCs provide an alternative repository for that liquidity, and so do other private payments media. Similarly, faster payments arrangements in aggregate allow individuals to hold lower balances in transactions accounts, as opposed to more remunerative assets they might hold. In any of these cases, to continue attracting funding, the banks are going to have to raise the interest rates they pay on their accounts. The subsidy begins to disappear. Similarly, the effect of faster payments or of alternative payments means that can readily be, the effects of faster payment systems or the effects of alternative payments means that can be readily tapped from a bank account, make it easier to move money into and out of banks on short notice. And such innovations are going to always generate concerns for financial stability. But the biggest challenge for the central banks from the digitalization of payments arise from the safety and security of the payment system itself. And as I said, this is true whether or not the central bank in question has specific responsibility for oversight of the retail payment system. First of all, as the entity in charge of the currency, the central bank will be perceived by the public as responsible for the workings of retail payments. Secondly, since disruptions to systemically important payments could easily spill over into the economy at large, a central bank cannot afford to ignore them. And these considerations become even more important as new entities outside the standard regulatory framework become major players in financial activities. Possible mismatches between the expectations of behavior for traditional financial actors and the newcomers can lead to financial turmoil. And that's been the experience, for example, of crises in the US repeatedly, where the stability of the banking system has been assaulted by troubles from shadow institutions, the trusts in 1907, savings and loans in 1980, and investment banks in 2007. It is not inconceivable that a non-bank payment system provider could play a similar role in future crises. The potential power of these technologies also leads to worries about their abuses. Every new technology creates such a worry, of course. But for electronic payments technologies, the worry comes from the ease of the scalability of these abuses. Counterfeiting, money laundering, and fraud may be technically more difficult in an electronic environment. That is, the agents are going to be that are involved in these kinds of activities will need new specialized skills. But once a technique succeeds, it's more easily and more rapidly replicated in an electronic environment, causing widespread havoc. Finally, privacy. At the outset, a fear of the loss of privacy is mainly a deterrent to individuals' adoptions of a new payment solution. But as the solutions become adopted, the scalability problem means that privacy breaches, when they do occur, are likely to be more widespread. And individual responses to such breaches are themselves going to be a potential source of instability for the payment system. So, let me summarize. For the most part, any form of innovation in digital payments leads to similar operational concerns for central banks. While monetary policy is most directly affected by CBDC, it's unlikely to require rapid adjustments to policy implications, and therefore, for operational purposes, is not going to be the first line of concern. Bigger concerns, however, are going to arise from the threat to banking stability from the increased ease and speed of the withdrawal and transfer of bank money. The solution there is going to have to be improved bank regulation and improved liquidity provision in emergencies. Those will be the first lines of defense for these concerns. The biggest challenges, however, are going to arise from the need to adapt the central bank to new payment system participants and to the technology-based issues for security. Now, that means a change in the attitude in the central bank. Those technologies become part of the concerns and the expertise of the central bank. And that is a big challenge for a central bank to take. Thank you very much.
Thank you very much, Professor Khan, for this excellent presentation. I think you've highlighted a number of the key challenges faced by central banks in this area. A further one, of course, is the issue of interoperability of these CBDCs cross-border, which can have financial stability risks at the more systemic level. And perhaps we can return to that in the Q&A round. I want to now turn to the next presenter, who is David Kuo Chuan Lee, who is professor at Singapore University of Social Sciences, and he will be talking about central bank digital currency development and challenges. So building on the last presentation. So Professor Lee, please go ahead.
Thank you very much. I would like to thank the organizer for inviting me today to do this presentation. And I hope that you can hear me and also see my slides on the screen. I have 20 minutes, but I do have quite a lot of slides, so I will go through them fairly quickly. But you're most welcome to download the report from the ADB website, as well as for me to share with you the summary of these slides. There are some views which are mine, doesn't represent my colleague from the ADB team, but that's where I start today about the implication of CBDC for Asia, and to give some examples for us to look into much deeper. This is the agenda today. I will go through the definitions, opportunities, the recent development, objectives, motivation, consideration, implications, and also beyond CBDC. First, let's start with the definition and models. The definitions by BIS is the one that's used in this report, and there are many other definitions, and even through time, BIS report has changed its definitions as well. And there are four main points: is form of digital money dominated in national currencies, a direct liability of central bank, complements banknotes and reserves as central bank money, and accessible to the general public or provided through the wholesale network among licensed institutions or for cross-border transactions or settlements. And this is one of the tables that we have devised to look at the central bank issue money, as well as central bank authorized, though not issued by central bank, as well as others which include e-money, corporate issue money, as well as cryptocurrencies. I have no time to cover them, but you're most welcome to take a look in the report. And there are two types of CBDC at the moment. One is a wholesale CBDC, could be used for monetary policy operations. It's usually among the banks for settlements, and of course is managed by the central bank. For the retail CBDC, it refers to widely circulated currency available via the e-wallet to individuals and firms for making retail payments, transferring money, and also receive government fiscal incentives and subsidies. I will elaborate a little bit more on that on Project Orchid of Singapore later. Now, for the CBDCs, the main objective is for P2P transactions and transaction through intermediaries. These are different models. The P2P transaction and transaction through intermediaries. You have the direct or two-tier models, and of course the UTXO, which is used in Bitcoin, and the state-based model, which is used in Ethereum. These are the two most popular methods that are used in CBDC, especially in Asia. Now, let's talk about opportunities and risks, which Professor Khan has talked about. So I'll run through it quickly. One is, of course, convenience, and you can, of course, do offline without any connection to 5G or 4G, as well as sometimes without electricity, you could do transaction P2P. It's for inclusion, not only for financial inclusion for individual, but also for corporate inclusion. And I will highlight the Project Bakun of Cambodia, how they have included a lot of new licensed corporates into the payment system, and also technology risk mitigation. The fourth is accurate economic activity measurements. And fifth is monetary and fiscal sovereignty, and that's important for a lot of policymakers to retain that. And the sixth is interesting, is managed anonymity, though there are a lot of privacy concerns, but there are solutions to address those privacy issues. And also we have the elimination and lowering of trusted third-party costs for inclusion, because the settlement is instant as compared to real-time gross settlement, which is not really real-time. And then there are more statistics of financial inclusion, innovation driver as well with smart contracts and other corporate inclusion into the system. And then, of course, the distribution, such as the project ORCID, that you allow direct provision of short-term liquidity to a specific group of people, and also to restrict consumption away from something which the government don't really want them to consume on. And finally, more clarity on the currency in circulation. And for risks, there are plenty of them as well. The risk of bank runs, which have been mentioned, the risk of financial disintermediation of the incumbents, and there are also technical and security risks due to power outages, poor connection, legal and supervision risks, which there are still a lot of gaps in the countries regarding regulation, issuing, use, and circulation and supervision of CBDCs. There's currency circulation risks with inadequate open digital infrastructure. So the design of digital infrastructure become important because it has implication many years down the road. And the emergence of CBDC derivatives and engineered products, which will speed up the transactions as well as exert pressure on the financial system and therefore stability. And attracting valuation premium during crisis, this is one major issue of whether CBDC should have interest payment or not. So far, the conclusion is that it should not be. Whether it should have negative interest payment is another issue to be discussed. And there's uncertainty surrounding design and monetary policy management, because we still do not have enough studies on that. And there's loss of convenience with custody of private keys and fake wallets. You could download the fake wallets and then the entire wealth is being taken over. So those are some of the issues that we need to think through in design thinking, as well as financial inclusion, whether we actually, including public for other activities which will affect the financial stability. Now, there are some recent development in Asia. You can see that the DCEP project, the Digital Currency Electronic Payment project, which China actually linked any digital currency with the payment structure. It is a very interesting approach because any digital currency will have to have a payment infrastructure, and therefore the design itself becomes important. The ECNY has been rolled out over time in different stages. The most successful one that I've seen is Project Bakun. It is not a CBDC project, but it's a blockchain-based settlement system. They have actually tokenized US dollar as well as the Cambodia national currency, and has included a lot of licensed institutions. Because the settlement is instant, therefore there need not be a lot of reserve, which is what is preventing a lot of new licensed institutions to join the payment system. And I think Project Bakun has solved some of these issues. The Project Wubin has gone through five phases and now into implementation. And then there's a project in Aton Lion Rock by Hong Kong, China, UAE, Bank of Thailand, and BIS as well. There's also a Hong Kong pilot program, which is getting very interesting. Let's look at objective motivation and consideration. These are some of the reasons: provide trust, complement central bank money, offering opportunities not possible with cash. I'll address issue of data and privacy protection, as well as to increase financial inclusion. And one of the interesting things is that the three-layer models are being adopted by some Asian countries to look at the issuance of CBDC, and then look at the payment system, and after that to look at how you can actually monitor with authentication, registration, and query function. There are a lot of details in the report, including the ledger infrastructure, the wallet and funds, the incentives, the offline governance, I have no time to cover them, including convenient, secure, and resilient, fast and scalable, interoperable, flexible, and adaptable. Basically, it is a menu choice for central banks who would like to design their CBDC. The pros and cons are being mentioned, but I have to mention also about stable coins, because Singapore is promoting stable coins, especially for G10, with new regulation and new incentives. Now, this is interesting because not only that one has to trust in the government, but also have to trust in the corporate as well. You have to trust in the cryptocurrency system. There are three trust systems here, which is a lot more complicated than just having a CBDC that is direct, and you only have to trust in the government, or the indirect, where you have to trust in the government and the intermediaries. But stablecoins is a lot more complicated, but it's being promoted. And then there's also decentralized finance, which are being advocated by many countries, including Australia, Singapore, focusing on smart contracts. This is some of them has already been implemented as an experiment since last year. And more importantly, is the implication for financial stability in Asia's developing countries. So while the digital local currency may be a good way to de-dollarize, which some of the African countries and Asian countries are thinking, there's a lot of risk. There's a risk that the CBDC may not be able to maintain stability in the event of lack of liquidity of foreign reserves, or when the market has lost confidence in the financial position of a central bank. There's no free lunch. The substitution effect between the two currencies as central bank authorized reserve will be an area for further study, especially the impact on the exchange rate system. The higher velocity and transmission speed of CBDC and payment system may warrant more research to assess risk. So it's not as simple as wanting to de-dollarize. There are a lot more issues to be investigated. And then there's a dependency on foreign currencies. The CBDC from large countries may crowd out digital money from smaller countries, leading to over-dependence on loss of economic independence. And the use of unapproved stablecoins as a medium of exchange in the digital economy can undermine the monetary and fiscal policies and pose challenges for monitoring and tax collection. And then there's also financial imbalances. Introducing CBDC requires careful monitoring to prevent unintended credit expansion and the formation of asset bubbles. And transitioning to CBDC needs efforts to minimize uncertainty and potential financial crisis. And CBDC can offer traceability and transparency, enhancing confidence and trust in the financial system. The competition between CBDC and deposit or sovereign bonds is another issue. CBDCs and stablecoins may compete with deposits and local sovereign banks, creating substitution effects. Borrowing in foreign CBDCs can introduce uncertainties and affect exchange rates, requiring close monitoring. And beyond CBDC, we can see that there's Project Nexus from Singapore. It's for bilateral linkages to multilateral linkages, because every country has their culture, the payment system and regulation, and the MCBDC project or Project Nexus can link up with many countries trying to have a certain standards. And this project is already started and is getting very interesting. Basically, you will have faster speed for payment, you have higher security, you have greater transparency, you have wider access, and it is, of course, with lower costs. And then there's MCBDC project by Hong Kong, Thailand, China, and UAE. And the objective is to increase efficiency, overcome inefficiencies, reduce costs, enhance traceability, simplify regulatory compliance, as in the case of Project Nexus, and to facilitate real-time funds transfer and atomic payments versus payment for foreign exchange transaction, and probably will extend to payments versus delivery. And then, of course, the Thai and Hong Kong corridor network using on the CODA platform, enabling peer-to-peer transfer, reducing settlement layers. This is the technical structure. It's very interesting. I have no time to talk about it, but it is good to look into it. And then I mentioned about Project Barcon. I think this is something that is very interesting. Again, it's on the open source Hyperledger Iroha blockchain framework, and it's been very successful. And they have really actually through this the MBC, the central bank, actually operate the core system, but it is a financial institutions that is the payment gateway among themselves. It's the corporate to corporate payment gateway. Okay, there's also a purpose-bound money, which is by Singapore, called the Project Orchid. And this is also very interesting. It is about programmability, but not programmable money, enabling money to be directed towards a specific purpose without requiring money itself to be programmed. More important is fungibility. Once conditions are met, digital money is released and it becomes unbounded, once again without constraints, preserving it used as a medium of exchange. And there's a common protocol, work with different ledger technology and forms of money, including CBDC, tokenized bank liability, and stable coins. So there's interoperability. It's very interesting, and I think the Project Orchid will have wide implications. There's other options which I have no time to talk about. You may look at the report if you wish to. And the MES also have the Project Orchid report. It's a multi-layer, multi-phase exploratory project. Come to our FinTech Festival in November. It's very interesting. There will be a lot of demonstration and that you could see with some of the minimum viable projects. And these are some of the things that they've done: government vouchers, commercial vouchers, government payouts, managing the learning accounts. And also there's real-world assets that we talk about in Hong Kong. They have done that. It's very interesting to look at the RWA using smart contracts. And there's also in Australia, you could look at some of this CBDC project using the two-layer environmental sandbox production, real CBDC, real cases, high standards. They are already working on the real-world assets that both in Asia and in Australia. And this is some of the structure that we can look at: tokenizing invoices, tokenizing T-bill, and so on. You also can see real estate, trade finance, private equity, and VCs. In conclusion, I think digital currency is a primary tool to transition to a digital economy. Government in Asia are really very much advanced in those areas. It's important to cooperate between public and private sectors. And a lot of projects that MES, Australia, in Asia, is a joint project between the public and private sectors. Interoperability is essential for cross-border trade, continuous research, improvement, and exploration of CBDC is essential, and countries must participate in international regulatory coordination and to learn from each other, and the benefits of CBDC, including connectivity, trade opportunities, and also digital trade agreement, which Singapore is doing with many countries, are absolutely important, because without a digital trade agreement, data storage and privacy will remain a hindrance. And the Asia Development Bank prioritizes regional cooperation to enhance connectivity, competitiveness, financial sector cooperation, suggesting that CBDC can promote transparency, narrow the digital divide, and deepen the capital markets. So thank you very much. My time is up, and I would like to pass it back to the organizer. I hope you enjoyed the talk. Thank you.
Thank you very much, Professor Lee. Excellent presentation, very comprehensive. I think one of the important issues, certainly since the end of last year, has been the calls for increased levels of regulation in the private cryptocurrency market and even on stablecoins. And I was interested in some of the comments you were making on stablecoins and whether, retail CBDC will eventually, take over that, or whether there could be some coexistence of these two types of currencies in the future. But perhaps we can return to that in the Q&A round. I would like to now turn to the next presenter, who is Heng Wang, Professor of Law at Yong Pung Ho School of Law, Singapore Management University, and also an adjunct professor at the University of New South Wales. Please go ahead, Professor Wang.
Well, thank you so much. I hope you can see the slides.
Yes.
So, yeah, thank you. I think it's been a great honor to be here. I would like to thank the organizer for having me here. So what I'd like to say is build upon the excellent presentation by the previous speakers, and to look into the uncertainties we're facing regarding the digital money. And what do we see that actually, as mentioned earlier already by the previous speakers in their fantastic talk, that we are already seeing uncertainties. Thinking about the issue like cybersecurity, we're already seeing some of the CBDC experience, ranging to a broader issue like the implications, for the society. So I would like to talk about, what are the uncertainties, faced by governance concerning digitalization, particularly here looking to CBDC, central bank digital currency, and also to think about any solution for those kind of the uncertainties. And the arguments is about, adaptive governance may be probably one of the first step, but they still have a lot of challenges. So, so first, let's look into the issue about, what are the uncertainties come from. I think that's when we look into the digitalization, there are a number of, uncertainties, but I think that's the source of those kind of uncertainties can be categorized into three camps. The first one is about the imperfect knowledge. That means science, means technology. So we see that, fintech or regtech or other technologies, we are not always being 100% sure about the possible, problems, glitches or others. You can think about smart contract, you can think about cyber attack, you can think about the CBD's experience we have, so we don't really fully understand the knowledge or the technology. So that may have unintended effects or unpredicted problems. And second issue is that, for all source of uncertainty is about incomplete knowledge, which you can call so like a knowledge gap. Because we think about digitalization or CBDC, they have issue about financial systems, they have issue about crypto, they have issue related to the technology, issue about security, issue about data. So actually, we have those kind of knowledge connected, held by different stakeholders. So basically, you have a kind of silos, governance silos or data silos, which means you have a public sector actor, you have a private sector actor. This knowledge are actually spread across different sectors, different stakeholders. It's not easy to get a full picture of that. And secondly, if we see currency or as a competition, not every actor is willing to share all the information. So the information even want to share that may not necessarily be fully shared, or they even have a manipulation in theory. If we see other network, they may have potential knowledge manipulation, or they only share part of the information with some of the rest of the ecosystem. So these are challenges. We also can see another example like data silos. The third kind of sources of uncertainty may come from unpredictability. And here, probably we look into more about unknown social or society responses. So what they will respond to, say, retail CBDC or wholesale CBDC. And these are not really the same. If you look into euro, digital euro, as a recent example, you see a obviously different view in that regard. So those kind of the uncertainty come from these three sources. You can think about data sharing, data flow, or privacy. These are some examples where we can find those different sources of uncertainty. And actually, adaptive governance may be one of the ways to embrace uncertainty through balancing stability and adaptability or flexibility, but they also have challenges. So now let's look into, potential solutions or potential first step. I don't see that's a silver bullet, and actually, obviously, it's very challenging. But I see that's actually when we navigate through those uncharted water of digitalization, including CBDC or digital money, and we obviously often encounter the issue about how do we balance between stability and flexibility according to the changing landscape, according to the evolving role of regulators or central banks and so on and so forth. So obviously, if we look into the central banks or regulators, and the key issue is about stability. So, you want to make sure the price, financial stability, monetary stability. So that includes economic, social, and even, for the psychological stability. And also the stability here means that, to realize the goals, so it can mean that the governance structure and standards will be stable over, relatively, stable over time. In this way, the industry or the actors, private sector actors won't see, bumpy roads, a lot of changes, which means a lot of problems or transaction cost. Another side, we need flexibility. Here, flexibility means the attitudes within an institution. There could be public sector like regulators. There could be, private sector like industry. They want flexibility because they may have, crisis if a cyber attack, or they have an issue about, spillover effects of foreign countries, stable coin issue in another country, stable coin issue in another country, or foreign CBDC may have any problems. They may have spillover effects, to another country. And then people may say whether it may cause issue like run on central banks because CBDC is central bank's money. So these are kind of emergency issues. If that happens, then you need flexibility, to give fast response, and that probably don't necessarily go through a normal process because cybersecurity and others, you have to fix that very soon. And so that's an attitude towards within institutions, and also probably an attitude towards standards because technology is fast changing and the use cases and so on and so forth. That means more revision, experimentation, innovation. But of course, here you have challenges. You may think about regulatory sandbox. However, the different countries have different rules, which means that it's hard to build regional regulatory sandbox because different countries have different national approach. So experience from country one may not necessarily easy to be used in country B. And also we see that, how do you, adapt to the fast changing landscape, as mentioned earlier by other speakers, CBDC work with a living ecosystem, which also interact with possible with stable coins, private money, fast payments, and so on and so forth. And also the policy imperatives may also change because the different countries may have their different approach over time. And also they may be affected by the landscape. Thinking about if major economies like EU, US and others, issue CBDC, they may have a lot of implications for the rest of the world. And also in terms of the solutions, when we're balancing those stability and flexibility, it's important to think about, learning. Because when we think about how to balance those stability or flexibility, it's not always easy because we don't really have experience as we see in the era of the pre-CBDC stage or era, because we don't really have those kind of the digital version of fiat currency. So we probably have to learn. Here means that peer learning, learning from your peers, in the financial sector, in technology sector and others, and to try to forge, common grounds, and that may be helpful to, build a coherent system which lowers the transaction cost, but also may help to avoid those frictions among different systems. And here the learning may also apply to individuals, besides peer learning, group learning, they may also apply to individuals, which means that the decision makers or the even other actors in the public and private sectors. There are at least three, as you see here, for learning. Key points for here. So one is that to build a problem-solving collaborative network. So that means how do we solve the uncertainties, when we go to digitalization? And here you may say, okay, what I bother to involve in this learning, say if I'm not interested in issuing CBDC, I want to make clear that I do not argue for or against issuing CBDC, but the reality is that, we live in a world where they have a CBDC project, even for countries or stakeholders who are not considering issuing or CBDC, the reality is that you probably will engage with some actors down the track if they issue CBDC. So which means that it's hard to avoid those scenarios. The international financial network is changing. So you have to engage with that to shape the landscape in a way that is fair, in a way that is mutually beneficial. So these are something I think that's probably not only involve actors that are considering CBDC, but also involves other actors, because you want to make sure that you shape the landscape and you are not in the menu, you're actually on the table. So here we see that for the problem-solving collaborative network, which means that involving public sector, private sector, because we know that, as mentioned earlier, the knowledge come from different sectors. We have to break the silos, including governance silo to data silo and other. One issue here is about how do we redefine the questions over time? Because that, we see one example, or is that why or do we need to say considering issuing CBDC, or what does CBDC, what is CBDC used for? You probably get different answers. Some of them will tell you financial inclusion, but you also have the issue about whether how can you deal with that if you think about remote area, and also the CBDC may still have to connect it to internet over time, and who provides those kind of the hard copy or hard digital wallets for CBDC, for example, in remote area. Or you may think about, okay, I'm thinking about financial stability, and of course you have to deal with the issue like financial disintermediation. Or people may think that just because of currency competition, fear of missing out. And then of course you have the challenges. How do you make sure that you do that for the best interest of your stakeholders? Or people may think about efficiency for cross-border CBDC. So here we think that redefining questions may range from what's the purpose of the CBDC, or what's the purpose of the digitalization, to how do you think about the role of the regulators or central banks? Because central banks in the past are not really the major player for technology innovation, but CBDC here impose new tasks for CBDC, for central banks and regulators, because even if you collaborate with private sector, it does not mean that you all rely on private sector, because as you see when you mint the money, you probably have to keep something close to your chest. So those are kind of issues where you see those kind of questions that you probably have to keep on asking yourself and redefine that over time. And also to building trust, it's really crucial, because think about at the end of the day, the money is people may say it's in your brain, or because no matter technology itself does not really change the scenarios where the users want to use that. And also that may also involve issue if I'm a smaller economy, how do I deal with that? Because how can I avoid dollarization or currency substitution and those kind of issues. So that's important to build trust, not only by users, but also by different actors of the network, private sector regulators of different countries, international organizations, regional organizations, and so on and so forth. And also it's very importantly for those networks also to provide kind of public good. Because when we look into the CBDC, it's very important to think about smaller economies, because they are not necessarily being able to have the human resources or the financial resources to develop technology from start of the scratch. And also, if we think about CBDC, it's such a universal, or can be used in very wide range of use cases. And also you have the issue about how do you maintain the system? Because if a cyber attack, that means you are more demanding for maintenance of the system. Think about if CBDC used widely, maybe like a version of ATM system we're using today. Even if you have the money, it doesn't make sense for you to change the ATM today, overnight. It doesn't work. So it's important that for us to build a network, that to build a trustworthy, transparent, and also well-designed CBDC system, if we want to go down that path, that can be used for smaller economies, and they have trust about how it operates, how cybersecurity issue, how they be maintained over time. So that's really important. Otherwise, it could be a huge problems, because CBDC is a large ecosystem that you heavily rely on, that involve crucial issues like data, digital identity, and that is crucial financial infrastructure that involve even broader issue like national security, because they may be used for payments, may be used for transportation, they may be used for financial markets instruments, and they can be used for whatever context you can design down the track. Because now we are facing the issue that we build those we have technology first, and then we explore their use down the track. And the second point for learning here is about, the knowledge co-production. So here means that it's important, as mentioned earlier, to break the silos. The silos means the silo among different industry or sectors. And also, as mentioned earlier, public-private sector that involve different national boundaries and at international, regional, and domestic level. So these are many silos you have to go through if you think about, even within a central bank. We give one example. If we want to think about CBDC, digitization, we also think about what are the implications, which is for environment. I love the theme of this conference is that actually they also built into the issue about climate change. For example, if we think about CBDC or digitization, that means we also build an extra layer of financial system or infrastructure, which means also extra layer of energy consumption. We already live in an environment which is hot enough. So you probably don't need, as someone from Singapore, I think that's probably, you don't necessarily need an extra temperature increase in that regard. And here you have the issue about how do we want to make sure the CBDC, as example, is environmentally friendly. So we're thinking of, how do you build those kind of environmental consumption or efficiency into tendering requirements if a regulator, try to seek the potential technology solutions for CBDC. And secondly, it's also not only about how CBDC can be environment friendly, they also involve about how CBDC can contribute to sustainable development. For example, how they maybe use smart contracts to give credits for those businesses or users which are environment friendly. And how do you provide incentive for them to move in that direction, and that makes helps how they contribute to the circular economy. But here, for those kind of issue like CBDC and climate change or energy consumption or sustainable development, they are silos. So, central banks, if you go to monetary agents, department, they say we deal with monetary issue, not necessarily with sustainable development. If you talk with sustainable department within central banks, they may say, okay, sorry, we are dealing more with the sustainable finance. Or if you look into the legal department or of division, they may say we're dealing with legal issue. So you see those kind of silos, or you like sustainable development and CBDC. It's not always easy because not really have synergized efforts in that regard. So that's one of the issues that we need those kind of knowledge co-production. We need to think about that well in advance, because you have a narrow window opportunity, for example, for logical production and to implement that. Because for CBDC, they may have a currency competition. So nobody want to, people may want to move faster, and then you have the problem. How do you, do it correctly in the short term? And also that's involved next question about ad hoc with a long-term solution. Ad hoc one means how do you deal with cybersecurity? Long-term means that, for example, how do you build an ecosystem or technology that is green and so on and so forth. And also third point, as mentioned earlier already, how do you, promote transparency, legitimacy, and accountability? That's crucial for trust. And also here you have a balance between, do you want rule-based, very clear rules, detailed rules? And like MiCA, we see that in EU, or you want a principle-based approach like US is doing. But here, people may say that, maybe rules, rule-based, very detailed rules may have a problem because it may be static, it may be avoided. A principle-based one have also their disadvantage because they may be in general. And also you need to engage with the actors, industry, to provide them guidance, because industry may ask you, yes, this is a principle. For example, we want to be sustainable good for sustainable development. Can I do this or not? So for principle-based approach, we probably need to have further engagement, constant engagement with the industry and so on and so forth to provide guidance. So that's something we need to bear in mind in that regard. And here we want to see some challenges, because we think about the trust. Trust here may come from institution-based trust, institution environment, or they may come, but here you have the problem that, as we mentioned earlier, if you like international atmosphere or international level, CBDC don't really have a very strong institutional environment yet, although we may rely or we will work closely with international organizations, but the geoeconomic dynamics may make that more difficult. And also trust may come from process-based one. So that means you develop on reputation experience, but they probably only work for those actors which has good reputation. They may not happen for everyone, and experience is also lacking here. Certainly, for characteristic-based trust, which means that look at the culture and groups, I think they probably only work for some groups. Not every groups have those kind of necessarily those characteristics-based trust, and so we see those kind of the challenges that trust is not easy in these three perspectives. To conclude, and here I want to see that because I'm running out of time, here are some QR code you can scan to download my recent paper on that. To conclude that digitalization requires us to deal with uncertainty. And here CBDC means that we have additional tasks for central banks and regulators. An adaptive governance may be a useful way at first to start with, but importantly, we need to balance between stability and flexibility. And to build trust, it's very important to go to the future landscape of digitization. Thank you.
Thank you very much, Professor Wang, for these very concrete and clear remarks on uncertainties linked to CBDCs. I think an issue that deserves further consideration would be the specific risks for emerging market economies, which may have, of course, lower levels of financial development and greater exposure to risks related to regulatory arbitrage on CBDCs. Perhaps we will have time to come back to that in the Q&A. Let's see. We will now turn to the two discussants for this session. The first discussant is Chen Hongyi, who is Senior Advisor at the Hong Kong Institute for Monetary and Financial Research. Please go ahead, Chen.
Yes.
For 15 minutes.
Okay, thank you very much. Thanks for inviting me to be a discussant for this very interesting workshop. So we have three very great, excellent presentations. So I want to focus my discussion on CBDC. So let's see.
See the slides, yes.
Okay.
Yes.
Now, first thing I want to say, what is new about CBDC? Like Professor Khan just said, there's the rapid development of this digital payment. But the digital payment, say for example, credit card, all these fast payment vehicles systems, and then the CBDC, what exactly, given that this all these different kinds of digital payment, what is new about the CBDC? What do we mean by CBDC? Basically, CBDC is sort of like a central bank money. It's directly a liability of a central bank. But then, if we just, given that the fast development of digital payment system, now why we need a CBDC? So what's the necessary? What's the impact? That's the question I have been thinking, and then also I have read the different report. But on this point, it's not so clear. So today in my discussion, I want to focus on the possible impact of CBDC on, first of all, the monetary policy implementation. Then the second is on the commercial banking and the financial stability. And then I will talk about the M-Bridge, which is sort of a CBDC connection between different central banks, this project. Okay, so CBDC, we have people are thinking about two types of CBDCs, a retail CBDC, the wholesale CBDC. If it's just a pure wholesale CBDC, we already have it because, say, for example, in the US system and then in many financial systems, all these commercial banks, they have an account with the central bank. So all the money creation is, central bank basically inject liquidity through the commercial bank. So that in that sense, we already have a sort of a CBDC. It's just the sort of a technology is different. It's not a coin. The system is already digitalized in terms of like a wholesale CBDC. But if it's a retail CBDC, then what that means, to me, if say, for example, if given the current technology, theoretically, we should have everybody should be able to have a wallet, have a digital wallet, which directly connect to the central bank. Then we have this kind of like everyone sort of in theory have an account with a central bank, and then the central bank can directly inject money to this wallet of different individuals. If that's the case, that's what I think in sort of like a retail CBDC. If that's the case, then what would be the implication for monetary policy? So then, important things, then the CBDC, from the central bank account, like the wallet can have like an interest. The central bank can say, oh, I give you, if you the wallet or the balance in the wallet can have a interest, or we can doesn't have an interest bearing. Then the monetary policy implementation, basically, so the current system of monetary policy, basically you just inject the liquidity through the financial system. Then theoretically, central bank can inject money through this sort of like a digital wallet, the retail wallet of each individual. So you can bypass sort of like a commercial bank. Then what would be the implication? The implication, because the current system, the commercial bank, they create a lot of money. It's a bigger money creation machine. But then if the case is if everybody have a wallet with directly with a central bank, then you don't need basically you don't need a deposit insurance. All the money is central bank money. And then this money is safe. It's a direct liability of the central bank. There's no need to deposit insurance. And then also you don't need basically you don't have a run. You might still have commercial bank might have some like made bad decisions, but all the money in the digital wallet you don't have to worry about. There's no point to have a run of this digital money. And then also for the exchange rate policy, say this cash convert to other, it could be more effective and more efficient. Now, if that's the case, that will have a huge implication for the whole commercial banking, because the commercial banking right now is you get everybody's deposit, and then it's a cheap deposit money, and then you lend it to someone, you take you sort of like a financial intermediation. But if everybody has a sort of wallet to the central bank, then for the commercial bank, in order to, on the liability side, you have to issue some kind of like a risk, interest rate bearing sort of asset for people to buy, and then you sort of give out loans. So this whole process will change. And then commercial bank is sort of like you issue a bond, issue a certificate for people to put the money in the central commercial bank. And then on the asset side, you lend out the money. But all the liquidity management is within the sort of like a CBDC environment. That way, you change the whole current sort of business model of a commercial bank. Then you basically you don't need a deposit insurance. And then in terms of the money creation process, it could be much smaller, because now the commercial bank, they get a deposit from the public, and then they lend it out within all through the process. They have this multiplier. But for example, if everybody has a digital wallet through with the central bank, then the commercial bank has to issue some kind of like a certificate of deposit, or it's a maturity difference. It's sort of like a maturity transformation, but then the money creation process could be much slower. And then also the commercial bank will be more focused on sort of find out a good project, and then sort of the risk management, the whole process will be different. This is also, there's an example in a case, say for example, in China, there's a China Development Bank. They don't have a retail branches all over the country. They just issue bonds to raise money, and then they lend it out. Sort of that's what I have in mind. If everybody have a digital wallet with the central bank, then the whole banking business, they basically, you have to issue some kind of like short-term notes, bonds to raise money, raise funds, and then you lend it out. That will be the new sort of model of maturity transformation. But that way, the whole risk management and then monetary policy implementation process will be completely different from what we have right now. And then also, the money creation process will be different. Say, for example, Martin Wolf, he have an example for UK. He said about 10% of the UK banking lending has financed through like as finance business investment in sectors other than commercial property. About 97% of the UK money supply was created as a byproduct of commercial banking business. But then if we have a wallet with a central bank, sort of like a CBDC, then the money creation process will be completely different. Then the central bank will have a more direct control of the money creation process. Also from the physical side, for example, during the past 3 years, we have a COVID, different government will have like want to give people money, inject money, then that will be easy. Then, you through central bank digital wallet, you can inject every, digital money, CBDC, into everyone's wallet. Then in that sense, it's easier to implement physically. And then also the monetary policy can be more effective. You can impose kind of like interest rate on this CBDC, or you have put a negative interest rate for people to spend. And then, so I'm just raise this theoretical issue for people to think. If the CBDC becomes a sort of like a digital wallet in a retail sense, what would be the implication for the whole banking business, banking system, and then also for the monetary policy implementation? Of course, that's what Professor Khan and also Professor David also mentioned. There's a huge, if that's the case, there will be a huge new technology build up, because the central bank has to run all this digital wallet, and then there will be a big technology spending for the central bank, because right now all the accounts are built through the commercial bank. But however, if there's a two-tier CBDC system, if central bank through commercial bank to issue CBDC, according to my paper with like Professor Pierre Siklos, that kind of like implication will be very pretty trivial in a way. What would be the difference from the current, say for example, the fast payment system or this credit card? The impact will be pretty much trivial. But having said all these are just experimental, because no big economy has already, used the CBDC in a large scale. Now, my second focus on for the discussion, it will be the sort of like CBDC on cross-border payment, because not a big impact if we have a CBDC, that will be on the cross-border payment. It will make it cheaper and faster and more transparent and accessible. Because right now, the cross-border payment is through sort of a global network of correspondent banks, which involves multiple intermediaries. As a result of this, they have very high costs, and then low speed and low transparency. And it's very complicated operationally, because say, for example, if you send money to to say, for example, some country in Brazil, maybe you have to go through New York, and then a big bank in New York, they have a correspondent relationship with some bank in Brazil. Then they, sort of finally transfer through sort of a middleman, a global bank. Usually it's in a financial center, for example, in London, in New York, then you go to different countries. So it's very complicated, and then also very high cost, and then with limited access, because in some, like, less developing countries, you might don't even have that kind of like correspondent banking system or relationship. So right now we in Hong Kong, we MA and then also Bank of Thailand, PBOC and the BIS, they build this sort of Enbridge project would just directly connect the CBDC of multiple jurisdictions. Usually it's a custom built distribution ledger system to support a sort of real-time peer-to-peer cross-border payment. This is still, the project is going on, hopefully it worked out. So the vision is to advance cross-border settlement and in central bank money, and then support the use of local currencies in international transactions, and then also create opportunities for new and innovative payment products and services. Of course, while safeguarding the currency sovereignty and the monetary and the financial stability, each central bank is the exclusive issuer or redeemer of their own CBDC. Only domestic commercial banks can request issuance, redemption of their local CBDC. Central bank can settle balance and transaction limits for their commercial bank. No domestic CBDC is required, as this Enbridge project can be connected to the existing real-time global settlement system. So I stop here. I thank you for your attention.
Thank you very much, Dr. Chen. Excellent comments on the presentations. I think you touched on two main issues, which are the implications for the banking system and monetary policy transmission. The second point, very interesting and important point on cross-border payments. I'll come back to the presenters after the next discussion with their views on the questions raised in the discussion part. So our final discussant is Assistant Governor Na Ayudha, who is from the Bank of Thailand at the Payment
Please call
Systems.
me Siritida. Yes.
Okay, sorry, Siritida. Assistant Governor Siritida. Please go ahead for 15 minutes.
Okay, so thank you. Let me start by thanking our ADBI for the opportunity to join this discussion, and Professor Khan, Professor Lee, and Professor Wang for their insightful and comprehensive presentation. Actually, I don't have any slide, and will mainly touch on my view on the paper. Digital currency have attract the attention of central bank worldwide, including the Bank of Thailand. And CBDCs are being actively explored since 3 years ago, given the opportunity they can bring the new innovation of payments and also new challenges of financial landscape. The first point I would like to touch on is the opportunities and risks associated with CBDC. I have to say that I agree with several points of Professor Lee has raised earlier, and would like to share my view on what I perceive as the key opportunities and risks in relation to CBDC. For me, the main opportunity that come with CBDC include the following. The first one is safe and reliable digital central bank money. CBDC will provide a safe and reliable digital form of central bank money if, in the future, private digital currency become widely adopted, and the effectiveness of monetary policy and stability of the financial system could be undermined. CBDC therefore could become a tool to help safeguard monetary and financial stability as well as be a safer and a publicly accessible alternative to other form of digital currency. Given the fact that at present, there are many cryptocurrency being actively used globally, especially in cross-border fund transfer transaction. Secondly, more efficient implementation of what we call helicopter money. CBDC can help the implementation of any welfare or government help to be more efficient. Direct transfer of CBDC can be designed and made right to the actual target group intended for such a stimulus package. Thirdly, driver of inclusion and competition and innovation. CBDC could serve as an open digital infrastructure for both public and private sector to build value-added services and open more avenue for inclusion, competition, and innovation. Programmability feature of our CBDCs, interoperability of CBDC platforms, and partnership among stakeholders in financial sector, in particular, will be a major driver of useful innovation. On the other hand, I have three key concerns associated with CBDCs, which of course depend on how CBDC will be designed and implemented. The first one is this intermediation. If CBDC are designed to be interest-bearing and are considered an attractive alternative store of value, this could lead to banking disintermediation as households and businesses might decide to substitute their bank deposit with CBDC, causing a deposit outflow. Second is about bank run. When it's time of economic or financial market turmoil, a systemic bank run could occur, given the advantage of technology, a perceived flight to quality from bank deposit to CBDC could take place digitally at unprecedented speed. It will fly very fast. I think this is in line with Professor Khan has brought up earlier as what he considered a bigger concern from CBDC on banking stability. I do agree that improved bank regulations and liquidity provision will be needed as the first line of defense, but those risks and concerns are still there. Thirdly is a public trust. Building and maintaining public trust in the central bank as the issuer of CBDC and the operator of national system will be essential for a well-functioning, secure, and resilient monetary system. In addition, the issue of data privacy, cyber resiliency need to be taken care, and also the enhancing digital literacy to consumer to prevent cyber fraud and crime is also necessary. Sometimes we forget about the literacy to a consumer, but I think that is a very necessary to have them know how to use the digital payment safely. And I would like to add the introduction of CBDC will present different opportunity as well as risks to different stakeholders. Therefore, through consideration of policy option and risk mitigation options is required before any decision on whether to issue CBDC can be made. We cannot deny technology and innovation. I think that everyone agree on this. In my view, the earliest understanding their risks and mechanism, the better preparedness and readiness we become. An approach worth taking for any central bank is to prioritize capacity building and take necessary preparation for CBDC issuance alongside the industry. Although under current condition, there might not be an immediate need for CBDC right now. The second point I would like to touch on is governance, which is among the key design consideration for CBDC. Robot CBDC ecosystem would involve several stakeholders. Therefore, it is necessary to design a framework around governance to ensure that CBDC are appropriately used, managed, and operated. In CBDC designing process, it would be useful to also discuss the clear laws and responsibility of the operator, regulator, service provider, and other participants in order to avoid confusing among all the stakeholders. The rulebook could be crafted to ensure a common understanding among participants. In addition, there should be a governance body that include representatives from key stakeholders to oversee the overall system and the strategic and management direction, as well as operational guidelines to ensure that CBDC will be well functioning and robust. Given the uncertainty and the pace of technological development surrounding CBDC, I believe Professor Wang's suggestion on using adaptive governance approach to help decision makers strike better balance between stability and adaptability is an interesting idea. With such approach, if different expertise and viewpoint of various stakeholders are properly taken into consideration, I believe that our CBDC governance framework could be more agile, flexible, and better able to keep pace with rapid change and uncertainty. I would like to now briefly update you on how things are progressing regarding the Bank of Thailand CBDC initiative as some use case. For the wholesale CBDC, the Bank of Thailand has undertaken several pilots under Project Intinon since 2018, which mentioned earlier, and has later extended testing scope to cross-border payment with other partners, including HKMA, UAE, and PBOC, and the BIS Innovation Hub Hong Kong Center under the Enbridge project. We have successfully completed the first pilot under the Enbridge using wholesale CBDC for real value cross-border payment transaction. Right now, 20 participating commercial banks across 4 jurisdictions, including 5 banks from Thailand, collectively execute exchange transaction and cross-border fund transfer in 4 different currencies on the Enbridge platform. On behalf of their corporate clients to support international trade in the value of over 20 million US dollar right now. So going forward, the Enbridge project will continue building and testing the technology to improve existing functionality and add more feature to the platform, taking into the consideration of policy, regulatory, and legal implication. And following this, the Bank of Thailand will consider pursuing experiment in more real-world setting further. And as for retail CBDC, we are about to complete our first limited scope pilot with 2 banks and 1 non-bank. We will then access the result of the pilot test to further consider suitability of a technology and CBDC design with no plan to roll out retail CBDC at the moment. Considering that we now have a very, very efficient real-time fast payment system called PromptPay, which are widely used all over the country and is very popular right now. The total transaction per day is about, is growing up and it's about like more than 45 million transactions per day. So we now focus on the stability and scalability of the existing system right now. So I think that this is all from me, and thank you again for the opportunity to share my view today.
Thank you very much, Assistant Governor Siri Tida. Excellent remarks. I particularly was interested in your comments on the risks of CBDCs on potential bank runs and disintermediation and deposit outflows, you know, as a result of interest-bearing CBDCs, for example. We now turn to the Q&A round where we have 15 minutes left. I can see that the Q&A box is already very active. So what I would propose to do now is to pose questions to each of the three main speakers. I've essentially summarized what I've taken from today's discussion, and I have a question for each presenter based on what was discussed earlier. And also in the answers provided, the speakers can reflect on any of the comments made by the discussants. So the first question goes to Professor Khan. So I think the issue of interoperability of CBD systems is very important, particularly in relation to, you know, cross-border payments evolution in this new type of world. What is your view on how to mitigate these types of risks? That's the question, and you can also reflect on any of the other comments made by the discussants. So you have 5 minutes. Please go ahead.
Before I get to that, let me talk a little bit about a couple of things I thought were extremely interesting in the comment of Dr. Chen and Assistant Governor Sirchida. I do disagree with something in a small way that Dr. Chen was arguing. He seemed to be arguing that a that a system which would be a hybrid system, a system in which the banks would be in fact in charge of the nitty-gritty details of running a CBDC, would be a much simpler system. I agree with that. Not entirely simpler, because you're still going to have a lot of expertise in the central bank for how that thing should be operated. But seemed to be arguing that aside from that, this was not going to be quite such a big deal. And I guess what I disagree with about that is it still is going to have an effect in terms of whether there's interest-bearing or not interest-bearing CBDC. And here I want to go back to what Assistant Governor Sirchida said, that indeed there are going to be several things you might want for that system to be doing. It might make it easier to make government payments, and that's a very good thing if you wish to have that be more convenient. But having it interest bearing is going to be a different kettle of fish entirely. And I think you're going to find that if you make it sufficiently lucrative interest bearing, you're going to find a very big change in the effect on the banking system, no matter whether or not you're dealing with it as a pure account-based system with the central bank, or dealing with it as a hybrid system where nominally this is going through the individual banks as well. That aside, and by the way, I wanted to thank them both for excellent and interesting discussions that they were giving. Could you go now back to the question again? Sorry.
Okay, so the question was just about how you view the risks to interoperability and cross-border payments related to CBDCs and how to mitigate those.
I think that the plans that I have heard about, I'm not an expert on them by any means, but they actually do a very good job of that mitigation in the first place. The fact that these arrangements are designed to work through the central banks, providing the payments directly into the system, means that there's going to be quite a clear demarcation of how the dangers could flow from one country to another. Mm-hmm. The bigger question for stability, it seems to me, is for interoperability, is a fear that indeed not going through one of these systems, but going privately could be disruptive in itself, as people stop using the currency of a small country and start favoring using dollars or digital currencies in another currency as well. That's where the interoperability problem, I think, is going to really arise.
Okay, Professor Khan, thank you very much. Professor Lee, are you there? I would like to ask you a question about how you view the evolution of the cryptocurrency market in a world of CBDC, particularly retail CBDC, and any other comments you wish to make in response to the discussants. So Professor Lee, go ahead. Okay, he's not here. Okay, so Professor Lee is not here. So now I will go to Professor Wang. So one of the comments made in the discussion earlier was on the risks related to bank runs, which is a key factor on, the topics that you were discussing in terms of uncertainty. So what are your views on the bank run risks related to CBDC evolution, and any other comments you would like to make on the discussion?
Yeah, thank you so much for the really useful and also insightful comments and also the questions. I think that's actually, yes, I think bank runs are a really crucial issue to be addressed in the CBDC landscape. I think probably they have two kind of bank runs. I would see that. First one is the traditional commercial bank runs, because of the, users may nowadays be able to shift to central bank digital currency in a much quicker way, because you click on your app, then you move for that. There may be a risk, but also they have counter arguments. The counter arguments that may not necessarily be so serious because you have an app, so they don't really go to ATM to queue for that. They may wait and see, and because it's just 1 second, you click on it, unless they have the issue with the scalability, or in terms of transacting in the short term of large volume of a request, they may not be so serious. So you see, it's uncertainty. You can argue either way. That's for commercial bank runs. But secondly, they may also have an issue about, maybe for central bank, because this is a CBDC, which is issued by central banks. It's different from the traditional scenarios where you are using, you are thinking about deposits on the commercial banks. And here, CBDC are the money that are issued by central bank. And maybe you can think of, if it's possible at all in real life, to shift to a foreign CBDC or stable coins, your private money, whatever. So they may also have new issue for potentially a risk of the runs on central banks. So this, at the end of the day, I think that's involves about which country we're talking about, because at the end of the day, the trust of the governance, the rule of law, the dispute settlement involving issue like even if you have a privacy, how to get protected. They actually, all these factors will be exemplified, I think, in those kind of scenarios. So how do we deal with that? I think that's also end up being the key issue about the trust. How do you build the trust? I think that's actually also mentioned by Assistant Governor earlier. That is, how do we build that? And that is important, that to actually, as I mentioned earlier, to have a transparency, accountability, and and those kind of the fairness in the governance of CBDC. Because when people get to know, okay, I'm kind of confident, in how it operates, either domestic or international or cross-border one, and I'm sure that how will be remedies available if a data leakage, any infringement on consumer protection, and also I have a confidence in the capacity of the industry, of the stakeholders, private, public sector. So that'll be important. So I think that's really important. And secondly, I think it's also important to, as mentioned earlier, to break the silos. So it won't be an easy job just for one central bank to say, okay, let's do that. And actually involves the intermediaries. So for example, what happens if intermediaries get bankrupt or insolvent? Who will deal with that? I think they need clear rules and division of labor in that regard. It's not always so clear in that regard. And thirdly, it's also about knowledge, So how do you share the knowledge, how to build the capacity, because that involves different sectors, and whether the stakeholders are ready to share those information. So for example, for cybersecurity, because that involves IP, intellectual property, they may involve national security, and also how do you share the data among different central banks? So these are many issues that will be relevant in that regard. And so I think that's also, so to sum up, I think that involves the issue about, build the trust, build the logical production, and make sure the transparency and the confidence and accountability, and so on and so forth. Yeah, thank you.
Thank you very much. And just one follow-up question. Do you see any specific risks for emerging and developing economies, also to Professor Khan, in terms of CBDC development?
Yeah.
Compared to advanced economies?
Yeah. So I don't know whether Professor Khan, do you want to go first or maybe maybe I go first. So I think that's actually for advanced economies and compared with smaller economies. I think the real issue is about public goods. So I think that's where you cannot think of a smaller economy to develop the CBD system by themselves. So it's basically it's too difficult, too demanding for knowledge, for funding, for for the time and so on and so forth. So that's really important, international and regional organizations to build the trust and build a public goods for that. And also we're thinking of, if you have a linkage with CBDC, it won't be easy to break it because you have infrastructure like ATM system, you're thinking of that. And also think about ecosystem standards, technology standards, IP, and so on and so forth. And certainly thinking about, the wider implications for the industry, financial sectors, because the impact on commercial banks, there's also impact on, the new entry of big techs, tech companies. And also you have the issue about consumers, how new business will develop. And certainly thinking about IP, if it's an IP, who pay for that? Who pay, whether you pay those kind of charges and so on and so forth. Fourthly, cyber attack, and maintenance, who pay the cost of that. That involves software, and fourthly, hardware, who provides the hardware, because you still need hardware. Think about ranging from the data server, iCloud, and finally, also issue about climate change and how to make sure that you deal with that, which is the theme of our conference today. I think it's fascinating. How do you make sure that work in a way that is being sustainable, which may be more costly? So that's a huge demand for international public goods, which heavily rely on international regional organizations working with central banks, other stakeholders in that regard. So I think that's need a far-sighted, foresight, and also need to act quickly because you have a time pressure and a narrow window opportunity. Thank you.
Okay, Professor Wang, thank you very much. And the final word then to you, Professor Khan, on emerging market specific risks.
Well, as Professor Wang said, the technology problems become more acute, more difficult. But I think it's very interesting to notice that the first attempts at CBDC, the first experiments that I actually gone live, have not been with established economies, but with developing economies. So I'm not so sure that technological disadvantage is quite as big as we might fear it is. And the other piece where there's an advantage for emerging markets, possibly in the the smaller problems of entrenchment of interest that might be causing a slowdown or unwillingness.
Hello, everyone. This is Seung-Ju Baek, the Deputy Dean of ADBI. It's a great pleasure to open this session. Also, I'd like to express many thanks to the speakers and participants for joining this session. The topic of this session is climate financial risks, innovations, and central bank and regulatory challenges. As you know very well, climate change poses severe and urgent challenges, as well as its serious impact on the environment and the people. It is one of the biggest threats to economic stability and sustainability. Moreover, climate-related financial risks have the potential to affect the safety and the soundness of banking system through physical and transition risks, which affect various sectors of economy and may affect access to financial services. Therefore, the central banks and banking systems of countries needed to clearly understand their climate-related financial risks, including physical and transition risks, and develop more innovative financial regulatory and risk management frameworks and capabilities to identify, measure, monitor, and control those risks. In this context, the topic we are touching this afternoon is timely and relevant. In this session, we will share and have insightful discussions any possible ways of monitoring and identifying climate financing risks, enhancing understanding of central bank and financial supervisory practices and challenges, as well as how to promote green financing through green bond. Okay, during the session, I'd like to encourage the participants to actively post questions in QA box, or please use the raising hand functions on your screen. Today we invited 4 distinguished speakers and 2 discussants. Now I am pleased to introduce the first speaker, Professor Sayuri Shirai, who will present on ASEAN Climate Finance Monitoring Dialogue and Platform. Dr. Shirai rejoined ADBI as a visiting fellow in July 2022 as a scholar and advisor for sustainable policies. She is currently a professor of economics on the Keio University's Faculty of Policy Management. She was also a member of the policy board of the Bank of Japan from 2011 to 2016. Dr. Shirai?
Yes.
Could you please start your presentation?
Yes.
You have 20 minutes. Yeah.
Yes.
Okay.
Thank you very much, Chairman. So today I'd like to talk about Asian Climate Finance Monitoring Dialogue and Platform. This is a proposal I made, and now I'm currently working with ADB, Climate Change Sustainable Development Department, to make it materialize. So today I'd like to share with you why I'm doing this and why it's quite our project is quite important. Okay. Screen, yeah. So if we look at the expected global temperatures, please look at left-hand side. If we just maintain current policy, it's expected by the end of this century, 2100, the global temperature is likely to exceed 3 degrees. So it's very clear current policy is not sufficient enough to cope with the climate mitigation. Now, a lot of countries, over 160 countries, they agree with Paris Agreement in 2015, and they submitted 2030 emission target to, under the name of Nationally Determined Contribution, NDC, to United Nations, and also a lot of countries pledged that they will achieve net zero carbon neutrality and by 2050. But even with this committed policy, there's a projection that global temperature is going to exceed 2.6 degrees. So the point here is that this NDC 2030 target not only ambitious to achieve Paris Agreement, which is well below 2 degrees or strive to achieve 1.5 degrees, but even this not so ambitious target are unlikely to be achieved with this policy committed under NDC. So certainly the government have to do much more to cope with climate mitigation. But also today I'd like to talk about this issue from disclosure and financial stability and the sustainable development market. And I guess everybody know the climate change, climate risk decompose into 2 types. One is fiscal risk on the horizontal axis, and the other one is transition risk. And right now, we are in the range of this current policy, so we're above 2 degrees. So physical risk is becoming very severe every year, but we haven't really, launched at ambitious climate policy yet. So we haven't really reached to the trajectory that leads to net zero by 2050. So we like to move our society and planet from this current policy to net zero by 2050. So this is what we are trying to change. Now, for Asia, this reducing GHG emissions is very important, and it's not so easy to do it. One, because Asia depends on coal plants, and the coal plants in Asia account for 20% of energy-related GHG emissions. And second, a lot of coal power plants in Asia are very young. Their average operating year is just 14 years, whereas in US, 6 years, in Europe, 45 years. So in the case of US and Europe, they can just wait until those coal power plants get obsolete, and then they can dispose it. But in the case of Asia, because a lot of plants are so young, so how to replace those existing coal plants or reducing emission on these existing coal power plants are very challenging. And then especially we have to focus on Asia, because developing Asia is expected to account for 70% of growth in global electricity demand in 2023 and 24. So unless we take more actions, Asia is going to be a very serious region which emit a lot of GHG emissions. Now, this is a forecast made by IEA. So let's look at the left-hand side, 2020, the People's Republic of China, their current amount of investment for clean energy area is $511 billion US. In order to get to the net zero by 2050 scenarios, the China needs to increase this investment as much as 2 times as much as current level. Now, in the case of Southeast Asia or India or other Asia, they need to invest much more on clean energy, up to 6 to 8 times as much as current level. So especially other Asia, they haven't really invested much in clean energy. So how to increase investment is a serious issue in Asia. In other words, Asia face 3 gaps. One is emission gap. They still emit a lot, and there's a huge gap between current emission and the emission committed under Paris Agreement. And second, there's a huge investment gap in Asia. They need to invest a lot on decarbonization, low carbonization, and clean investment, but the investment hasn't been launched much yet. Then finally, there's a financing gap. Not a lot of money is going to the emerging economies. So how to finance the investment to reduce emission gap is the biggest issue in Asia. Now, why the money is not flowing into the Asia yet, especially Asian emerging economies? Because investors are not willing to invest a lot in emerging economies. One, because there's a data shortage. For example, even basic data such as GHG, Scope 1, Scope 2, Scope 3 emissions, and the target are not available from companies. And second, a lot of domestic banks and investors are still having a limited awareness. Some major banks, they are increasing awareness, but whole banking system or investors, still their degree of awareness is in a preliminary level. There are active European investors, ESG investors, and they try to influence the companies in other countries, but so far their impact to change corporate sector's behavior in Asia has been limited. The third issue is that some companies try to disclose GHG emission or target, but their approaches are very divergent. So it's very difficult to compare across companies and across countries. The problem about current disclosure is that many companies tend to do cherry picking. So cherry picking means company tends to exaggerate the area they are good at in terms of environmentally friendly practices, but they talk less in the area they are not very good at. So the company tends to do this cherry picking. So its comparison is extremely difficult. So right now, there is a ESG score providers. There are about 12 famous global ESG score providers. I mean, those are useful, but they also count on this existing data. So they got to do some estimate on this missing data. And as you know, there is a divergent way to make estimate, and then methodology are totally different. As a result, this ESG score has a wide variation among data providers. So those are useful, but to be honest, it's not the same as credit rating scores. Credit rating scores, there is some variation, but it's not so big, so we can trust those data. But ESG data are far more divergent, and then given that actual data are missing, it's not really reliable. So this is the problem we are having now. One positive area is that we started to see some standardization of climate-related disclosures. So we started with this TCFD guideline. TCFD stands for Task Force on Climate-Related Financial Disclosure. This was initiated by G20 and supported by FSB. So this was the first standardized disclosure. But still, with this TCFD guideline, there's a whole bunch of different disclosure standards created by different initiatives. So still, it was very difficult to make a cross-country comparison. And then June this year, the ISSB, this stands for International Sustainability Standard Board, it was created by IFAS, international standard. And many countries endorse this ISSB standard. So finally, we started to have some kind of standardization, especially in terms of GHG emission, target, and etc. So this ISSB adopted this TCFD basic guideline. So a country needs to disclose information such as governance strategy, risk management, metrics, and target. But still, as I said, it's not really, not standardized yet at this stage. So thanks to ISSB, so we may see some improvement in standardization, but still far away to go. So going back to this TCFD disclosures, more than 100 economies supported this TCFD guidelines. But because this is voluntary in many countries, some countries made it mandatory, but most of the countries made it voluntary. So still, the idea is good, but it's very difficult to see comparison, okay? So corporate disclosure remain uneven and dispersed, so comparison remain challenging. And there are very interesting platform created by IMF, like Climate Dashboard, OECD, and PRI, WWF. Today, WWF will make a presentation about the approach. They are very useful. But at this moment, there are not much information about each country's actual disclosure and supervisory approach. So this is the area I'd like to work on. And so what's happened at this moment? So many countries, they announce they are doing this, they are doing that. We are doing this disclosure and that disclosure. But sometimes actual implementation can be very different from impression we obtain from policy announcement and guideline. And also, there is no platform, centralized platform, where we can get the information related to this disclosure and the supervisory approach. So therefore, if I want to get information of certain country, I have to go to their website. But in many cases, it's not much information in English, and also it's very difficult to make a cross-country comparison. So that is the current situation. So here is the objective of this proposal. So as you know, the climate risk, physical risk, transition risk, and those are translated into financial risk, such as credit risk. So we need, before we talk about companies, we also need to promote understanding and how to manage risk among financial regulators. In the end, by doing that, that will lead to more sustainable, trustworthy financial market and system. And then also we can probably promote financial stability related to climate change. So what this project is trying to do is disclosure is essential. Of course, disclosure cannot answer everything, but without disclosure, we cannot start anything. So I think we need to promote the awareness of climate risk and importance of disclosure and supervisory approach among Asian authorities. And also we need to get the fact about the disclosure and regulatory approaches in Asia and develop centralized policy for platform. So the objective, there are 4 objectives with this project. So 1, promote awareness among financial service supervisory regulators in terms of this climate disclosure, and then create forum, informal forum, provide 2-3 times a year, and to share information among authorities. For example, everybody knows Scope 3 emission is a supplier's emission. It's very difficult to make estimate, but we can share experiences. So that kind of informal forum is important. So we are thinking, hopefully start with ASEAN +3, Japan, PRC, Korea, but eventually we would like to extend to other Asian countries. In the meanwhile, I think we can do a lot of capacity building for financial regulators, enhance their expertise, and this is applied to all ADB member countries. And finally, we like to create portal at ADB, and then in a standardized manner, so that people have a better understanding and where they stand in terms of supervisory and the disclosure approach. So this is a phasing manner. So in the first stage, we like to focus on corporate level disclosure. After all, before we talk about financial sectors, stability and prudential policy, we really have to have a good, high quality corporate level disclosure. So we like to start with this. Then finally, by having this informal meeting, hopefully among ASEAN +3, we like to talk about informally about the challenges related to Scope 1, Scope 2, Scope 3 emission, and how to set target. And also, TCFD, ISSB, they have a climate transition plan and scenario analysis, but not many countries not understand fully what they need to do to promote corporate sector's climate transition plan and scenario analysis. So we can work and exchange view on this. And of course, we can also talk about other metrics. Country needs to disclose information, not only about GHG emission, but many others. So we can talk about that and how to set target. And then also very important thing is transition finance. Transition finance is becoming important. Japan is also one of the countries which initiated, and also China is doing transition finance. But I think we need to do much more to have a trustworthy transition finance framework. And so we can discuss among Asia, especially Asia need this transition finance. So this, I like to bring in this issue also during meeting. So these are just really friendly, informal gathering. And then so we can also talk about certification standard for bond. So in this way, maybe we can promote somewhat more standardization among Asia, so that Asia as a whole is able to attract more money from global investors, and then we can have more sustainable, good market in Asia. This is my book recently published. If you are interested in, you can look at ADBI homepage. It's freely downloadable. Thank you very much.
Thank you very much, Professor Shirai. I think you emphasized the importance of climate data disclosure to promote awareness of climate risks and to mobilize more funds for climate actions. You proposed a project to develop an online platform for standardized climate disclosure and information sharing. Yeah, which is, I believe, so essential. Thanks again, Professor Shirai. Now let me invite Ms. Teresa Raiman-Lin for next presentation. Ms. Teresa Lin is an advisor to the Bank for International Settlement Innovation Hub, Hong Kong Center, with a focus on green finance. She co-led Project Genesis 2.0, a project showcasing prototypes of tokenized green bond appended with smart contract-based carbon credit. today she will talk about the project Genesis. Miss Lin, please go ahead.
So thanks again for having me. Today, I'll talk about Project Genesis, and just a quick background on the BIS. The BIS is an international financial institution owned by member central banks, and its primary objective is to foster international monetary and financial cooperation while serving as a bank for central banks. The Innovation Hub was set up to explore how technology can support central banks and improve the functioning of the financial system. And one of the key themes of the Innovation Hub is green finance, which is what I focus on. And as part of the green finance theme, the Hong Kong Center worked on 2 proof of concepts on tokenizing green bond and also carbon credits. So Project Genesis 1.0 explored tokenized green bond. Oh, sorry, I don't know. Okay, sorry. So Project Genesis 1.0 explored tokenized green bond, and 2.0 went further to attach smart contract-based carbon credits to the digital green bonds. Both proof of concepts explored blockchain, smart contract, and Internet of Things technology, and also explored the public-private partnerships by working with large financial institutions and technology companies. I'll briefly talk about Genesis 1.0 and then spend most of the time talking about 2.0, as 2.0 is a build-on of Genesis 1.0. So Genesis 1.0 wanted to tackle a few issues in the current green bond model and allows for instant settlements. Secondly, because of that cost of issuing a bond, the denomination of each bond is typically high, creating a barrier for retail investors to participate. So by tokenizing the bonds, it can be fractionalized, and this can reduce the denomination of the bond and allow more retail investors to participate in the green bond market. And also, after investing in a green bond, it takes time and cost to verify whether the use of proceeds of that green bond were actually put into environmental projects. So by attaching Internet of Things technologies at the project sites where the green bond is funding, investors can have real-time information of, let's say, how much clean energy is generated with their green bond investments. So in this project, we worked with the Hong Kong Monetary Authority and private parties, including Standard Chartered Bank, Digital Assets, and we showcased 2 prototypes where retail investors can very simply download an app on their mobile phones and invest any amount into a government green bond. And they're also able to sell that green bond transparently on an app. And investors can also track in real time the amount of clean energy generated linked to the investment on that app. Upon completing the project, the Hong Kong Monetary Authority has recently launched the first tokenized green bond in February this year for institutional investors. Let me move on to Genesis 2.0. Genesis 2.0's primary objective is to address the greenwashing issue of the green bond market. And we worked with the UN Climate Change Global Innovation Hub and the Hong Kong Monetary Authority on this project. A bit of context for this project. So green bonds have been a very successful financial instrument. It has grown tremendously throughout the years and has hit the 2 trillion mark in issuance since 2006. But there's an important question to ask. Does the success of the green bond market really translate into real environmental impacts that contribute to the climate goal, or are they simply a tool for greenwashing? I.e., are they simply rebranding a normal bond with green label? So this is a question of additionality. It is estimated that to limit the temperature rise by 1.5 degrees Celsius, an additional average annual clean energy and infrastructure investment of around $3 trillion is needed by the end of this decade. And according to the IPCC estimates, and earlier Professor Arai also alluded to, that we are missing that goal. So in Genesis 2.0, this is exactly the issue we try to address. to ensure that green bonds are indeed raising the capital for projects that yield additional climate outcomes. So in this project, we showcase a proposed green bond structure by Masamba Thioe from the UN Climate Change Global Innovation Hub. The idea is to attach mitigation outcome interests to a green bond. Mitigation outcomes, you can think of them as a claim on future carbon credits generated by the funded projects of the green bond. So at issuance, when an investor invests in a green bond, in addition to paying the principal on the bond and receiving the bond in return from the issuer, which is the red part here, the issuer will also purchase future contracts of carbon credits to be delivered at maturity by the issuer, and that's the gray parts. And in exchange of that commitment of carbon credits futures, the investor would pay a premium to the issuer. So in effect, for the issuer, instead of waiting until the carbon credits are generated at the end of the project to realize that economic benefits, the issuer can get the funding that it needs to develop that clean project upfront at issuance. And this is very important for issuers who are not able to raise traditional capital, especially in developing markets. And for the investor, with a commitment from the issuer to deliver carbon credits generated by the project, the investor can also ensure that the investments in the green bonds will indeed be generating positive environmental impact. So this part is the innovation in the financial instrument element. Moving on to the technology front, 2 prototypes were also developed in this project with blockchain, smart contracts, and Internet of Things technology. And we were able to showcase the ability to automatically transfer and trade these mitigation outcome interests and track in real time the mitigation outcome data linked to the bond's life cycle. The first prototype was built with Goldman Sachs, All-in-for and digital assets. As you can see in this diagram, it simulated a straight-through process for issuance and transfer of MOIs on a permissioned blockchain-based platform. It allowed traditional finance parties such as issuers, custodians, brokers, dealers, syndicated banks to participate and approve the transaction when needed. And it also has APIs that links to the carbon emission data captured by Internet of Things devices at source. And this information is recorded onto the blockchain. And this allows investors the transparency of the green impact of its investment and have higher visibility of whether the issuer can deliver the full amount of carbon credits at maturity. Microphone. So the second prototype was built by a consortium made up of Interopera, a Thai bank, and 2 corporates, one being a potential carbon credit investor and the other a carbon credit issuer. And this is the proof of concept workflow, and they explored the potential linkage with national account of carbon emission and international trading of carbon credits under the framework of Paris Agreement 6.4. You can see on the top here. And this was enabled by the tracking ability of the blockchain. And on this slide, you can see a snapshot of the prototype where the investors can track the mitigation outcome data, which is the amount of clean energy that's produced on site. And this is captured by the IoT devices and directly recorded on the blockchain, and the investors can view it on their app. And as part of the project, we also engaged a law firm to produce a reference sample term sheet for the project, and this is included in the report if you're interested. I'll just end with some highlights of the benefits demonstrated by 2.0 Genesis. So for a green bond issuer, they can access cheaper funding provided by the premiums on the MOIs at issuance. And like I said earlier, this addresses the issue of additionality on green bond raise, green bond, and the green bond with MOIs can fill the financial viability gaps of the green projects. And this is especially important in countries with limited access to traditional finance. And for an investor, the carbon credits provide an objective definition of green impact of its investments and allow for real-time transparency and protect them from the reputation risk of greenwashing. And for the sustainable finance ecosystem as a whole, this structure can potentially deepen participation of financial investors in the carbon credit market, which can also help provide the liquidity and price discovery for the carbon markets and potentially scale it. And before I close, I just want to raise some observations we had from the project. So Genesis 1.0, we try to match tokenization with fractionalization for retail investors in the green bond market. And 2.0, we try to match tokenized bonds with programmable delivery of carbon forwards. And both of these prototypes showcase the art of the possible in terms of the use of IoT and blockchain for traceability and eliminating double counting in the case of carbon credits. But Genesis 2.0 also pointed out that the tracking and tracing of carbon credits on a global level will take a lot more time, as these carbon credits are currently issued under different schemes, and even with blockchains, they may be recorded on different blockchains. But the World Bank is working on a project called Carbon Warehouse, and they're making good efforts in this regard. And lastly, the project showcased that blockchain is a potentially very useful technology to tackle some of the shortcomings in the carbon credit market. First, because it can track provenance and avoid the reuse of the same carbon credits. And it can also be used for global tracking and combined with IoT tracking devices. And this can enable digital verification and programmability of delivery. Because currently, the verification of carbon credits can take a long time, up to months. But having these data that's recorded at source can allow that process much faster. And lastly, there's no current incumbent market in the carbon market. So it makes the adoption of new technology much easier compared to other financial markets. Thank you very much. And if you want to find more information of our report and also some videos of the prototypes and a podcast, you can go visit our website here. Thanks.
Thank you. Thank you very much for your presentation, Ms. Lin. You introduced the project Genesis 2.0, prototyping attachment of smart contract-based carbon credit to green bond, which is, I think, a very innovative way of mobilizing investment in green bond. Thanks again, Ms. Lin. Now, let me move to the next presentation by two speakers from Worldwide Fund for Nature, WWF, Ms. Maud Abdelli and Ms. Siti Koryatulizkia, who represent sustainable financial regulations and central bank activities. Mr. Abdelli is leading the WWF Greening Financial Regulation Initiative, which aims to engage policymakers, central banks, and financial supervisors, and support the integration of climate and nature at the heart of our financial system. Ms. Lizkia leads the Sustainable Financial Regulations and Central Bank Activities Assessment under the WWF Greening Financial Regulation Initiative. She actively engages the central banks and financial supervisors to discuss SUSLEG and SUSLEG results, identify gaps, share good practice, and offer support in 47 countries covered by the SUSLEG framework. Ms. Abdelli, you go first.
Thank you very much, and thank you very much for having us today. With you, it's an honor to present our initiative and our SUSLEG tracker tool during this IADB conference. So I will quickly go through an introduction, and then my colleague Siti, she will go through the key findings of our latest assessment and the key recommendations. But first, I wanted to show you that our SUSLEG tool is part of a broader initiative, which has been launched by WWF 2 years ago. And the main aim of this initiative, which is called the Greening Financial Regulation Initiative, is really to engage the central bank, the financial supervisor, and to help them to understand better how climate change and nature loss could impact financial and price stability, but also what is the role they can play. So the Greening Financial Regulation Initiative is a global initiative of the Worldwide Foundation. We are covering more or less 40 countries, and we are engaging the financial regulators and the central banks at two levels. International level with regular interaction with a lot of international forums, such as the Network for Greening the Financial System, but other international financial standard setters, and at local level through our national offices, we are engaging central banks and financial supervisors on the ground in a lot of different countries. We are very solution orientated, and for that we are developing a lot of content to support and to broaden this understanding of the interlinkage between our real economy, our lives, and the climate change and nature loss. And for that, we have developed 4 different development content area. The first one is called the Suspect Tracker, and this is a tool that we will present to you today. And the aim of this is to showcase what central banks and financial supervisors are already doing around the globe on those 2 aspects, and to share good practices, because we know that they are not moving at the same time, at the same level, and some of them may need support to integrate good practices in climate change and nature loss mitigation action. The second area of development are the publication of research papers. We are here trying to translate scientific knowledge into financial language so we can better integrate climate change, nature loss, but also broader social aspects into the financial system. The third areas of activity is capacity building. Here we are trying to provide as much as possible targeted assistance to central banks and financial supervisors, giving them an overview of the data, the tools and methodologies they can already use to integrate climate change and nature loss, but also developing capacity building activity, trainings, workshops, and supporting them in running some conference to promote those 2 key topics, and to make also the broader financial market to understand those topics. And last but not least, we are really trying also to help the central banks and the financial supervisors to push the financial sector to integrate those aspects into their financing, investing, or insuring decision making. If we go on the next slide, I will present you the key objective of the first tool we have, so the SUSPEC, the Sustainable Financial Regulation and Central Bank Activity Tracker. So the key objective of this tool is to assess and track the integration of all environmental and social considerations into financial regulation and central bank policies across the globe. So it is important to really understand that this tool has 3 main objectives. The first objective is to enhance the financial sector stability and resilience in front of the growing climate and broader environmental related financial risk. The second objective is to act as a roadmap, as our tool integrates a lot of indicators presenting a lot of different ways for central banks to integrate this aspect. It could act as a roadmap for them to integrate more and more sustainability topics into their activity. And the third objective is to provide more and more transparency on what central banks are doing at the moment, how they are doing it, and what can financial institutions also do to follow these trends. So the key user group of the SUSREG are the central banks and the financial regulators or supervisor, obviously, the international financial standard setter and other broader initiatives to understand what is happening on the ground in different countries, but also the commercial banks, the insurance to understand better what are the regulations in place in one country or another, the academics and the think tanks as well to better understand what is happening. It's really important to understand what is SUSREG. So SUSREG is a tool. It's not a rating tool. We are here to provide a diagnostic and to showcase what central banks are doing correctly to implement climate, nature loss, and broader social aspects into all their activities. So SUSREG doesn't give a score at all. We are just showcasing what the central bank are doing in one country, what their peers are doing in other countries, and what are the good practices that could be, which could be already replicated in a lot of different countries to bridge certain gaps. So SUSREG is built on different key blocks, let's say, representing the main activities of the central banks. So the first block is financial supervision. Here, we have developed a set of indicators to assess how the financial supervisors are integrating climate first, nature, but also the broader social aspect into banking, but also insurance supervision. So it goes from micro supervision to much macro financial risk assessment and supervision of those risks. The second main block is about central banking. Here, we are assessing how a central bank implement those aspects into its monetary policy implementation. And finally, the third block is enabling environment. Here we are assessing what are the key financial regulations in place to integrate climate, nature, and social aspects into the financial market functioning in the jurisdiction, and what can be the role of the central banks or the financial supervisor to broaden the understanding on those topics and to push the financial sector to act on those topics. So SUSREG is covering a lot of different countries. It covered 38 jurisdictions, and now we move to 47 jurisdictions across the America, the Europe, Middle East, and Africa, the Asia Pacific region. Those countries are representing over 88% of the global GDP and 74% of global GHG emissions, and 11 of the 70 most biodiversity-rich countries in the world. Most of those countries are part of one important, at least, international financial forum on climate change, nature loss, and financial stability or price stability, such as the Basel Committee on Banking Supervision, the International Association of Insurance Supervision, and the Network for Greening the Financial System. If we go on the next slide, so what's new this year in our SUSREG assessment? So first, we have added a lot of additional indicators to really make more precise and more targeted our assessment, and particularly on 2 or 3 key topics that are important for us, such as deforestation, integration of water-related risk, but also just transition initiative led by some supervisors. Second, we have added indicator on the enabling environment part to see how the central bank, the financial supervisor, or the financial regulation at large could also embed small and medium enterprise into the integration of climate change and nature loss financial regulation, and also the issuance of sovereign sustainable bonds. On the central banking part, we have added indicators on showing how certain central banks are starting phase-out plan to divest from some specific activities, and are also starting their journey to integrate just transition into monetary policy. On the geographical scope, we have added 3 more countries that are Paraguay, Slovenia, and Turkey this year. So the SUSREG annual report will be published at the end of the year. We will also update our online platform because obviously we also have an online platform in which you can find all the individual results of the assessment by country. And now I will leave the floor to my colleague, Siti. She will present you the key findings of the assessment this year, and we will be pleased to answer any question you may have after the presentation. Thank you very much.
Thank you, Ms. Abdelli. Okay, next, Ms. Rizkia.
Thank you very much, Maud, and also thank you. Yeah, so as mentioned by Maud, this year's assessment will be available by the end of this year. So some of the graphs that I'll present today is actually a result from last year. So maybe some of the statistics might be a bit outdated. But I give disclaimer which results, whether this is 2022 or 2023. So from what we found last year, we see that 52% of the countries that were covered by subtract has already issued regulations and expectations on sustainable banking. But the caveat is that this is simply looking at whether the country has the regulations or the expectations. So it doesn't look at how detailed the regulation is. This one is specific on one indicator. And also we don't look at the implementation of it. And similar to banking, the insurance also, 62% of the countries that we covered, they have some form of expectation for insurance business. However, the focus of these countries mainly has been very much on climate, with 69% are centering around climate, and with much lesser on broader environmental risk, and even lesser on social. And this is consistent for both banking and also insurance. We also assessed monetary policy and central banking activities. And our assessment found that the integration of environmental and social risk to monetary policy has been very, very limited across the globe. I think among the things that were done on the corporate asset purchase program and collateral framework was done by the European Central Bank, which actually conducted the monetary policy for the Eurosystem countries. However, this has not been done in most of the other countries in the world. And foreign exchange research management is usually among the most common way of integrating ENS risk into monetary policy. But even so, this has only been done by 1% of the countries. So the rest of the countries, they don't really have anything in place on this. And Korean targeted loan by central bank is also not very common in most countries. And surprisingly, this is actually mostly done in Asia Pacific. So we have found this green targeted lending in China, Japan, Singapore, and also Malaysia. But most of the countries in other regions like America and even Europe, the central bank does not really have targeted loan. And as I mentioned in the previous slide, that the center has been very much on climate, and we found that very few countries have deliberate expectations on nature-related risk. This includes biodiversity risk, deforestation, water-related risk, and etc. Only 20% of the countries listed this as part of the general consideration. So when they mention environmental risk, and they listed out all these nature-related risks as part of the issues, but almost no countries, only one in Asia Pacific, which is Malaysia, under their high-risk sector guidance. It's not a mandatory guidance, but it is guidance from financial institutions to manage and also assess the risks related to deforestation, biodiversity, and all nature-related risks coming from their clients. So most countries that have not issued any kind of guides or even minimum supervisory expectations that detail out what they expect the financial institutions to do on nature-related risks. And the graph that you're seeing now, this is a simple comparison of the countries from this year's assessment. So we have it ready for this year for the country in Asia Pacific. And under banking supervision, you see a few countries like Malaysia, Hong Kong, and Singapore, Thailand, and Philippines that are actually doing relatively well in banking supervision. And as mentioned, climate has been very much covered in this expectation, and social has been lagging compared to the other risks. And on monetary policy, most countries in Asia Pacific have not actually done or integrate environmental and social risk in a meaningful way into their monetary policy toolkit. The countries that is relatively doing well in this phase is China, and this is contributed by a number of aspects. For example, their treatment of green bonds as part of the collateral. They accepted green bond as the collateral. They also commit to include more green bonds and also limit investment in carbon intensive assets from their foreign exchange reserve. And also their targeted loan is, I think, the biggest, if I'm not mistaken, in the world under their carbon emission reduction facility. This amounts to more than 40 billion US dollar. And this is actually has been done also in some other countries, as I mentioned before, like Singapore, Malaysia, but at a smaller amount. And then under insurance provision, you'll see that this is less covered compared to the banking supervision. And Singapore is the countries with the strongest insurance provision when it comes to climate and also environmental risk. Singapore has actually issued the guidelines on environmental risk management for insurers. So this is quite a comprehensive guideline, which is designed specifically for insurance business. And the guideline also covered both sides of the business, underwriting and now we take the suspect result one step further by interacting it with some external score. So we took fiscal vulnerability and also readiness score from beginning. This is basically to understand the country's climate policy, which we took from suspect climate score in the backdrop of their physical risk exposure. And if you see on the bottom left here quadrant, these are the countries with the highest physical climate vulnerability, yet they also have a low climate financial regulation score. And unfortunately, this is the stark reality that climate crisis disproportionately impacts the most vulnerable populations. And most of the countries here are actually developing countries from Africa and also Asia, like Zambia, Paraguay, India, and so we believe that these countries need more resources to implement the measures and also support and assistance needed from the international community, and also knowledge transfer and also resource from the more developed countries. We also done this for the transition risk, but we can only do this until last year because IMF has not published a score this year. I think they take down the score. I think I just want to focus on a few countries. For example, Saudi Arabia, they have the highest transition risk exposure. They're being the top producer of fossil fuels, yet their suspect climate finance score is relatively quite low. So not even 50% of the strength of our suspect framework. And other countries with relatively high exposures, for example, like India, South Africa, again, these are mostly developing countries. They also have relatively quite weak finance policy score. So these countries are not very well prepared to the risk that they are going to face. We also, beside this suspect, we also have the Sustainable Banking Assessment Framework, or SASPA, in which we assess the sustainability performance of banks, mostly in Asia. And the result shows quite an interesting finding. So most countries, the banks are actually ahead of the regulation. But one caveat to this is that we only assess the biggest top 5 to 10 banks in each country. So we don't really cover a smaller bank. But I think that's quite representative of the banking private sectors in the country. So most of these countries, the banking sector is actually more advanced than the regulation. And the reason is because most regulators or central banks and financial supervisors, they tend to set the minimum standard for the industry for them to, to comply, and not like the what they have to aspire to achieve. And that's why they behave as how the graph is. A bit anomaly happened in Philippines. So Philippines, the BSB have actually issued an expectation on sustainable finance framework in 2020, and they are giving 3 years for the banking institutions to comply with their expectations in that framework. So this is already the 3rd year. And this year, we're also keen to know how the bank is implementing these measures. And we'd like to know more from the BSB and also from our success for if there is any improvement on the banking implementation of the annual consideration. And this is, I'm just going to flesh out a little bit and not going into details. Basically, this is what we do with our diagnostic approach. We do gap analysis to show to the central banks and financial supervisors the areas that they have performed well the areas that they need to improve on. We use this kind of diagnostic slide to present them and suggest them where exactly they need to prioritize in the short term. Yeah, and I only have a few minutes left, so I'll just highlight key recommendations that we made from last year's assessment. So the first one is that we urge financial supervisors and regulators to make climate and nature transition plan mandatory for both financial institutions and also for corporate. These plans include the strategy, financial plan, exposure limit, and any measures that's necessary for them to transition into a low carbon energy positive business. And we also believe that target settings is really important, and this has to be science-based and also having an instant target for that, and to also disclose based on the external, make sure that there's no greenwashing happening, even though they have set a target. And on insurance, we've seen that most expectation is very much focusing on investment side of the business. So we urge for it to be more balance of both investment and also underwriting. WWF Swiss has very recently launched a report on underwriting our planet, which basically talks about how insurance business can, especially on underwriting, can help address the crisis on climate and biodiversity. And then central banks also are encouraged to include all this consideration on climate, environmental, and also social risk in their monetary policy toolkits. And in the enabling environment, we believe that necessary tools, for example, taxonomies and also efficient carbon pricing, this will be really important to help foster transition of the whole country, including the economy, to a low carbon and nature policy. As mentioned by Maud, all of these assessments are available online for free in our website, so feel free to go to this website. We will update this year assessment by end of this year, and you'll be able to see all the countries that we covered. Thank you very much.
Thank you so much for your valuable presentations, Ms. Abdelli and Ms. Rizikia. You explained the framework of SOSREG and showed recent SOSREG assessment results for 47 countries. We could find several points to be improved for sustainable climate financing, including the limited integration of ENS into monetary policy. Thanks again. Yeah, now let's move to the discussion. We invited two distinguished discussants, Mr. Modasani Ismail and Mr. Satoshi Ikeda. Mr. Ismail is the director for the Finance Sector Office, covering South Asia and Central and West Asia regions at Asian Development Bank. He leads the ADB finance teams to deliver finance sector programs with emphasis on sustainable capital market, financial stability and banking reforms, as well as MSMEs access to finance. Mr. Ikeda is the Chief Sustainable Finance Officer at the Japan Financial Services Agency. He covers a wide range of issues concerning sustainable finance, which includes promoting climate-related financial disclosures by business corporations and financial institutions. First, Mr. Ismail.
Okay. Good afternoon, everyone. Thank you very much. First of all, thank you to ADBI for the invitation today to provide some comments for three great presentations that we heard today. I do not have any presentation, but I would like to provide sort of general overarching comments on the unifying theme of the three presentations, and then go into more specific comments on each presentation, because I think all of them deserve some praise, as well as I can provide some recommendations at the end of for each presentation. Also would like to congratulate Professor Sayuri, Ms. Teresa, as well as Ms. Maud and Ms. Siti from WWF for not only interesting presentations, but also the proposals and the projects that they're working on. And of course, very nice to see Ikeda-san again. We met a few months ago in Tokyo when ACMF visited Tokyo. Right. On that note, let me begin on the overarching theme. I think, as I mentioned, all three projects and proposals are very interesting and very beneficial from the climate finance perspective. So I think we should recognize that and appreciate the projects and the proposals. And I think what was interesting to me was that all three had different angles, if you like. The platform that Professor Sayuri recommended is all about data disclosure. How do we get consistent data, and how do we get information out there in terms of comparability and consistency? And then we had the proposal from Ms. Teresa on Genesis 2.0, which is really looking at combining innovation, technology, as well as climate finance. Adding the additional layer of carbon credit on top of the traditional green bonds tokenization. So it's double technology, if you like, double innovation on top of Genesis 1.0. Then, of course, the presentation from Ms. Mount and Ms. Siti on SUSREC by WWF also is very important from the perspective of helping policymakers and regulators, central bank and insurance to improve their policies and regulations on sustainable and climate finance. So I think all three have certainly benefits from that perspective. Now, if I go to each specific presentation with your kind permission, I'll start from the presentation on the platform by Professor Sayuri. As I mentioned, I think additional data, consistency in data is going to be very important and beneficial. One comment I like to add here is on the accuracy and the reliability of the information. So I think data disclosure is important, but equally important, in fact, a prerequisite of data disclosure and platform is how reliable the data can be. And I think in particular, I'm referring to Scope 3 emission, which we know, is very challenging. And in Scope 3 emissions, in fact, can be many times greater than Scope 1 and Scope 2 emission in some cases, but the way it is being reported are inconsistent, and then it also depends on how the reporting is done. So there's a lack of high quality data and accuracy for Scope 3. In addition, because Scope 3 is looking at value chain, whether that be on the upside or the downside of the value chain, there's also the risk of double counting as suppliers work with different value chain partners. So I think these are issues that we need to discuss and we need to find solutions. Once we have this in place, and I know it's a work in progress, it's not something that we can just perfect, over the next years. I think that the platform that Professor Sayuri recommended will be very useful. And the other point I wanted to make is that when I look at slide 18 on the proposals for regional forums and for seminars, capacity building, I think what will be required is really to work at the national level. Regional forums are useful for exchange of ideas and exchange of information, but we will need support, technical support, to work with regulators, policymakers, and SMEs in particular. When we talk of developing Asia, SMEs play a very important role. And so I think we will need that national level capacity building to help them with disclosures that we can then use in the data platform recommended. One final point on Professor Sayuri's presentation is on slide 5, and she rightly mentioned about coal-fired power plant in Asia being a challenge. And so I think this is why it's very important for us to understand the role of transition finance. If you look at countries like Indonesia, Philippines, Vietnam, these are all Pakistan, Kazakhstan, these are all countries that do have coal-fired power plant, and we need to find a way to provide them with transition finance. On that note, I'm leaving a link in the comment section for everyone on ADB's energy transition mechanism, which I think is a useful resource to look at how we can use transition finance to retire coal-fired power plant in advance of their expected age. Given that, as Professor Sayuri mentioned, that a lot of the coal-fired power plants in developing Asia are very young compared to European power plants. That's on the first presentation. And again, my congratulations to Professor Sayuri for the proposal. It's very interesting. Second presentation is by Ms. Teresa. I found this really interesting from an innovation aspect. Like I said, it's double innovation. because Genesis 1.0 was on digital tokenized bonds, and now we're talking about how we can use blockchain and DLT technology for, you know, to provide issuers the financing for carbon credit upfront, not waiting for the infrastructure or the project to materialize, but getting upfront, and of course diversifying the investment for investors. A few comments on this. Just on the use of DLT and blockchain, we know that this is not something that is easily accessible for emerging Asia and developing countries. There's still a lot of legal uncertainty on the use of DLT. And what we're trying to do is innovative. We're adding a financial implication on top of the use of DLT, IoT, as well as blockchain. So we need to really be sure on how the regulators treat this advance in financial sector. And because we are now having a contract between the issuer and the investors, how that legal uncertainty will prevail in case there's mismatch between the two. For instance, if we have anticipated carbon credit, we use IoT to have real-time information at the project site. But what if there are problems later on, expectations are not met? How will that be resolved? The potential dispute between investor and issuer, given some of the legal uncertainties we are seeing in the use of blockchain and DLT. Second, of course, that this is all very complex, perhaps not readily accessible by developing countries or emerging capital market, who, of course, are probably the one in need of greatest climate finance for transition, as we mentioned, as I mentioned just now, and who actually has a lot to offer in terms of carbon credit market. So one recommendation will be, how can we look at, first of all, making sure Genesis 2.0 is implemented properly with proper risk management, including risk of cybersecurity and so forth. And then how can we bring that technology to developing countries and emerging capital markets? And that capacity building needs to be end-to-end. We need to go from the technological know-how to regulations by the regulators and policymakers, use of blockchain technology and DLT, carbon credit, as well as supervision and consumer protection, including the cybersecurity, because these are all underlying frameworks that will be required to make the project work and beneficial for these countries. And my final comment is on the third presentation from WWF, Ms. Maud and Ms. Siti, on the SUSREG tracker. I hope I pronounce it right, SUSREG. I think, again, it's very interesting, and a lot of data can be very useful. And I think it's very good that the way WWF tries to use the information as analysis, as well as to provide information to policymakers and regulators on how they can improve their regulations and policies. I would, of course, recommend that we extend this to the capital market supervisors. I think that's very important, because capital market, although bank financing can be larger in volume, but if you think of additional financing, particularly for developing member countries, capital market, whether that be green, sustainable, linked bonds, these are all important instruments, transition bonds, to attract additional financing to help countries and corporates transition. Some of the comments on the recommendation, I think the recommendations were all good. Just that when we talk of science-based taxonomy and targets, we again need to think of that transition aspects. It's very good to have science-based targeting and science-based taxonomies, but we need to understand that different countries are at different entry point. And here I like to just recommend the members of this, the audience today, to have a look at the ASEAN taxonomy. The ASEAN taxonomy, I think, has been very innovative in the approach it takes for transition. That in fact, it is a transition taxonomy. It provides different points, threshold, and metrics so that countries can adjust whether they go tier 1, tier 2, or tier 3, and it provides them the pathway to that transition journey. Of course, the idea is that over time, the standards will have to be more strict, and there'll be sunset clause where what is acceptable now may not be acceptable 5-10 years from now. So I think those are the comments. One final point on SUSREG, I would say that this is very beneficial, and we can use this for analysis as well as improvement of policies and regulations. I'm personally not, I don't know whether this is the objective of SUSREG, but I'm personally not too keen on the idea of cross-country comparison, because I think other international surveys or assessments that tries to use cross-country comparison sometimes can create perverse incentive as countries try to, to beat each other. On one hand, it's good, competition is good, but it can also lead to anomalies in terms of data, practices, and information. So I think it's more important that we identify where are the gaps, and then we help the countries fill those gaps and improve their policies. Those are my comments on the three presentations. Once again, these are not criticisms. As I mentioned, all three are very good proposals and can really contribute to climate finance. Just some recommendations for considerations as we move forward. Thank you very much.
Thank you. Thank you, Mr. Ismail, for your remark. I agree with your opinion that in data disclosure, it is very critical. I mean, the data consistency, data credibility, and in comparability. Thank you very much. Also, yeah, thank you very much for your valuable comments on other speakers' presentations. Let me get back to speakers again to respond to the remarks of discussant. Okay, next, Mr. Ikeda.
Yes.
Yeah.
Yes, thank you. Well, I have a kind of a different takeaway from the three presentations. So let me go through those comments. Well, I just to facilitate my remarks, I'd like to show that my take 3 points for your ease of hearing my points. So, well, first, I found it very interesting from the WWF's colleagues' presentation on SESREG, and there is a certain kind of a elasticity difference between sustainable finance policy inputs and actors' response. The tendency is that the certain major banks tend to do more than the policy indicate, and the reason presented during the discussion was maybe the policies intended to set out certain minimum standards, but well, probably there are other reasons. For example, there are certain high expectation on major banks, global active one, but maybe just domestically active one. Anyway, that there is a certain growing emergence of certain hyper norms that dictate the behavior of the financial institutions actively financing in the region. But also, I think another reason is that central banks and the supervisors view that climate-related issue are a source of financial risk. So if it is a financial risk, and on the flip side of it is opportunity, if central banks and supervisors see that climate as a risk and opportunity issue, then probably banks and other financial institutions cannot be satisfied with going for just the minimum standards, because risk of opportunity cannot be managed by just abiding by the minimum standards. They need to actively manage those risks and opportunities And so probably that created a certain kind of a elasticity, the increased elasticity between policy input and actor response. And that kind of environment has been created not just by financial authorities, but I believe more actors are in action, particularly after climate and other environmental issue. It's all about the environmental policies or climate policies. So on the side of financial authorities, we are trying to set out certain sustainable finance policies which facilitate the provision of sustainability-related, climate-related, environment-related financial products to the financial markets. So that really deals with the supply side of sustainable finance. And actually the demand side, we cannot control. We mean financial authorities like Japan FSA. Because at the end of the day, that is mainly determined by the whole of the government as a whole, or probably the climate or environment policy and regulators of those kind of environmental policies. And for example, there is a certain policy development around the ban on internal combustion engine vehicles. And well, the global norm, I believe, is the ban on new vehicles of the internal combustion engine will start around 2035. That certainly creates a certain momentum for migrating to EVs or other forms of zero emission cars. But recently, the UK moved to postpone that kind of ban from 2030 to 2035. That certainly changed the demand side of sustainable finance policy, because that would give automobile industry to have more years to adapt to that new policy environment. So that certainly changed the demand for sustainable finance products and services. So, well, that should be taken into account in the overall discussion of how sustainable finance or climate finance policies as a whole in the Asia can be taken. But the final point is the role of financial sector. Well, my understanding is that financial sector is not necessarily in the driving seat for transitioning to sustainable society or zero carbon society, but it's accelerator with the certain information input to the kind of financial equation, the assessment of risks and opportunities. They can certainly price in those factors into the equilibrium of the financial markets, meaning that the share prices or certain bond prices will reflect those environmental related or climate related risks and opportunities. And that information, or that those prices will incorporate not only the current situation, but certainly incorporates forward-looking information. So it certainly reflect certain prediction of the courses of action that the actors will take. But through that mechanism, well, financial markets will act on certain rational expectations. So financial markets will reflect the certain consensus view on what rationally is expected in terms of the climate policies and environment policy. And with that, the effects of climate policies and the environment policies feed into the current prices, and that will influence the behavior of not only financial institutions, but overall business communities and even consumers. So that will accelerate the actions at the business corporation and consumers. That is a very important role, and that is why, as Professor Shirai put forward, that the accurate data and disclosure is critical. Well, in terms of the BIS, the Project Genesis 2.0, that is also that can also be viewed as the attempt to facilitate that incorporation of the certain information into the financial market pricing, and by doing so, that will facilitate the proper pricing of the carbon credit. Of course, as I said, that the in order for the carbon credit to be properly priced and at the same time properly used in the wider market participants, it is important that certain environmental policies are in place, and also, well, how that kind of carbon credit can be created through certain nature positive policies or other policies. So that also needs to be understood in the broader context of climate policies and environmental policies. But so I believe that the certain collaborative initiative between the financial authorities and the climate and environmental authorities is required to move forward with this kind of initiative. But certainly, I believe on the financial sector side, there are more that can be done in order to facilitate that kind of collaboration, and particularly that effort should be focused on facilitating the proper pricing of the future risks and opportunities in relation to the climate and the environmental factors. That's my comment. Thank you.
Thank you very much, Mr. Ikeda. I think you have a very quite a different point of view on the climate finance and climate actions, which are very impressive and interesting. Okay, now let me get back to the speakers again. Please briefly respond to the discussions if we have. Okay, it's okay. It is okay for the speakers to provide comments on each other's presentations also.
Yes.
First, Professor Sayuri.
Yes.
Yeah.
I really enjoyed this very insightful comment from the discussant. So let me give answer to those questions. So the first question is about reliability. Yes, so I only focus on the disclosure, but suppose corporate sector disclose GHG emission, is it reliable? So usually large company pay money to get sort of verification, right? from verifiers. But the problem is that those verifiers also depend on criteria, and criteria are created by certain organizers. But their approach is also divergent. That is a point. And there is no such thing as reliability right now, because everybody are doing totally different things. That's why basic disclosure, minimum disclosure is most important. And the second point is about emissions. I think double counting is not important here, because for example, when we talk about 2030 NDC target, the country only look at their territory, right? But at the same time, domestic companies, they operate a lot in a foreign country. And then company A's scope 3 can be company B's scope 1. So there is double counting. But the point here is not that. The point is that each company should know along this life cycle where this GHG emission concentrate. So awareness is important. So double counting is not the issue. That is my understanding. So I think we should first focus on a listed company, but even listed company, there's a prime market standard company and growth segments. So there is a sequence there. So important thing is we start with listed company, prime company, and gradually move to the smaller companies, but eventually can move to the unlisted companies. So sequence is important. About this coal fuel power plants, I think transition finance is very important in Asia, because right now, even advanced countries in Asia, they find it very difficult to attract money in transition finance. Transition finance means a company in the hard to abate sectors. They find it very difficult to reduce GHG emission because good technology is not yet available. So how to finance those sectors is extremely important. So I think Asia can work together to have a quite reliable transition financing scheme. So that's why I like to have this informal discussion and share experiences, and hopefully to have a somewhat more standardized approach in Asia to bring this money to Asia. The fourth point is so our project is a bit different from WWF, because WWF focus is based on expectation, right? Expectation on banks, and the expectations created financial regulator. But my point is, our approach is looking at what regulations they are doing. So actual regulation rather than expectation, because often expectation is they are saying, okay, large bank, we are expecting you to do that, but that's up to them. So it's implementation is very different. So our focus is actual implementation, and that part we like to have a platform. So that is our interest. And the final point, I really understand what Ikeda-san said. I fully agree. So this, this money side, we are talking about supply side. But we also have to have a demand side, investors. So how to promote institutional investors to come to this sustainable finance, that's not up to financial regulator, right? So that's up to government policy. So it has to go together. So that's why I said it at the beginning. Just looking at the financial side alone cannot solve it. So it has to go together. But here, what I want to say is, a lot of emerging economies, they need money to finance decarbonization. Right? But they cannot just wait and criticizing the advanced country haven't provided sufficient money. They also have to improve their disclosure to make it more attractive. And also even advanced country in Asia, they still find it very difficult to attract transition finance because investors are very worried about greenwashing. So that's why I'm saying Asia, developed country and developing country work together and to discuss about how to make more reliable financial system. Thank you.
Thank you, Professor Sayuri. Next, Ms. Teresa Lin. Do you have any response to the discussions?
Sorry about that. Yeah, thank you so much for the points raised about the project and the presentation. I think those points are very valid, especially Ismaiah's point on the legal consideration. Aside from the legal consideration on the blockchain, there's also, we found during the project, there's legal uncertainties even on the carbon credits itself. Whether carbon credits is a commodity or is it a spot market regulated, these are not very certain, and different markets have different views on this. And or is it a derivative or a forward futures, etc.? Because this would impact which regulator looks at the regulation of this product, and also who can this be sold to? Could it be sold to just institutional investors or also retail investors? So these are some of the questions that we also raised in the project regarding carbon credits. And to Mr. Ikeda's point on the carbon credits market, we also think that it is still a very much evolving market, especially in the voluntary carbon market. And because of, like I said earlier, it is a very market-driven market, and there's little regulations in this market still, especially the securities regulators. So we think the quality and the integrity of the carbon credit still has to be market driven, and there are some good I guess, initiatives happening in here. For example, the Integrity Council of the Voluntary Carbon Credit market, they're looking to create a baseline of the quality of the carbon credits. So this is a good way forward, we think. But we realize that also the voluntary carbon market has still quite a way to go in terms of quality. But having that data that could be sourced tracked to its source, that's enabled by the IoT devices as well as the blockchain. We think this could give more transparency on how the carbon credits is being produced, and that could help the development of the carbon market. So these are some of my responses, and thank you so much.
Thank you, Ms. Lin. Next, Ms. Abdelli. Please briefly comment on.
Yeah, Mod is probably on the go, so maybe I can give some remarks, and Mod, if you're available, you can get from there as well. So there are a few very great discussion points that was mentioned. So the first one is whether FastTrack will be extended to asset management. So this is something that we do plan to do in the future, but it largely depends on our resources as well. We've got similar feedback from our interaction with countries like Netherlands, because asset management is such a big part of their financial sector. So this is indeed in our radar. And it's also a great point of the transition point in the taxonomy. We do advocate for science-based taxonomy, science-based target, but also these are basically how we define green, for example. What exactly is green? But it doesn't mean that we don't recognize that there is a need for transition. And I think, if I remember correctly, Singapore has this brown, although they don't really have a separate taxonomy for brown, but they do mention sectors that are high risk, which is considered as brown, and some sectors or some activities in between, which transition from brown to green. And in our advocate of setting target, for example, we also, of course, advocate financial institutions to set transition targets for that. So it's not just a very forward-looking 50 years from now, but also what's the interim target to actually achieve those targets. And on the financial sector's role in this whole transition to low carbon economy, I think it's really important to acknowledge that this is a whole of society approach in which every single actors, including the government, the industry itself, and of course the financial sectors, they all have a very important part to play on. And although financial sector is not the direct actor of this transition, but they are the accelerators, and they can make the situation much worse than they already are. So that's what we all are doing right now, to basically make the transition much smoother. And there's one more question I think I saw in the Q&A questions. This is about weightage. Once again, I would like to emphasize that the objective of FastTrack is not to rank countries, who do the best, who do the worst. That's not our objective. So we don't actually do scoring. What we do is basically conduct assessment very objectively from our framework to identify in each country which are the areas that they have achieved and which areas that they need to improve on. But we understand that this comparison might not be very fair for the developing countries and all that. And for that purpose, in our annual report this year, we will actually do introduction of suspect score and also the country's income level to kind of highlight how much the countries are doing compared to the resources that they have in the economy, whether the rich countries are actually doing enough or not. So we'll present this in our annual report, and we'll update you when it's published around December. But again, just to reiterate, we don't intend to compare that this country is the best one or is doing better, but we focus on each country and try to help them do a gap analysis to point out what exactly they can do and to improve the regulation within that. Yeah, that's from my side. Please feel free if you want to add on.
Yeah, no, just wanted to add that thank you for the point on the inclusion of capital market into SOSRAG assessment. We do acknowledge that it's an important part of the financial sector, and it is our intention to integrate capital market assessment if we have enough resources to do so in the forthcoming years. Thank you very much.
Thank you very much. Yeah. Yeah, now I'd like to pass to the other participants for questions. So let me check with the QA box. I don't see any questions in QA box. Okay, may I ask a question to Professor Sayuri Shirai?
Yes.
Yeah, in your presentation, as major constraint, you explained that the data disclosure tends to be cherry picking.
Yes.
So actually, I asked you before, but many people, I think many people are curious about it.
see.
Do you have any idea?
Yeah.
Idea to encourage private corporations and financial institutions to actively disclose their information, their data?
Yeah, so cherry picking is the word we use in this ESG industries. Because suppose I'm a corporate company's sustainability officer, okay? And if there is no stringent criteria such as ISSB, because ISSB tell you have to disclose GHG emission in absolute amounts, right? Then you can use all sorts of, you can use part of scope 1, and then maybe you use denominator using some sales data or production data. So all sorts of things makes appearance very different. So that's why ISSB is giving more stringent requirement as for these GHG emissions. So unless we have such kind of mandatory requirement, then it's natural for the company to show some area which looks so good. So like they are doing a lot of environmentally friendly actions. So that is natural tendency. So that's why, just leave a disclosure on a voluntary basis and very vague, requirement does not really lead to the, encouraging company to reduce the GHG emission. So is it clear?
Yeah. Okay, thank you.
Yeah.
I don't think there is further questions now. Let me check again. Yeah, I just found the questions in Q&A box. The question is it possible to explain any role of digitalization, example, digital currency, may play in sustainable finance? I don't know who can answer to this question.
Well, I think it's a bit too early to talk about it. There is no connection with digital currency, but I think that one way is like what BIS is explaining. So using blockchain to make it more trustworthy about, for example, green bond. Green bond means we are supposed to provide those raised funds into green project, but in reality, we don't really know. And then what's happened to impact. So there are a lot of uncertainty. So, one way to do it is to have a transparency, this tracking approach, and then blockchain really make it possible. So that is one area I think really promising. Teresa, anything to say?
Ms. Teresa Rin? Yeah.
Hello, thank you, Professor Shirai, for helping me answer that too. We've also seen some proposals in the market about, so digital currency is all about programmability, right? Being able to program the money. And there are some proposals in the market where they are suggesting to have, let's say, reward citizens who do green with some sort of rewards on the money, or only allow certain money to be used on green use. So, for example, if let's say they have been using clean energy, and they can prove that, and the government could issue some reward, and that reward can only be used on other green products or green use. So these are some of the innovative projects that we saw in the market proposals.
Thank you. Thank you very much. Now we come to the end of this session. I know. So until now, we have very informative presentations and valuable discussions on the crime-related risks and challenges on financial regulations and central bank activities for sustainable climate change. Yeah, thank you. Let me conclude this session by thank you the speakers and the participants for joining this valuable session today. Thank you very much.
Thank you. So I'd like to start the final session of today's conference. It's a high-level panel discussion, financial technology development and central bank operational challenges. I am Sayuri Shirai. I'm currently a visiting fellow sustainable policy advisor at ADBI, as well as professor at Keio University. I also have a working experience as a policy board member at Bank of Japan in the past. So I'd like to chair today's panel session, and we are delighted to welcome distinguished guests from Central Bank of Australia and Singapore. The first panelist is Dr. Brad Jones. Can I see you? Yeah, yes. And Assistant Governor, Reserve Bank of Australia. And another panelist is Kenny Sky, Executive Director of Monetary Authority of Singapore. We are supposed to have another panelist from Indonesia, but there was some emergency things, so the person is not able to participate. So we have a lot of discussion with the Central Bank from Australia and Singapore. So today I'd like to divide this panel discussion into three areas. First area is not directly relevant to today's conference, but I'd like to ask you something about recent banking failure and stress, which happened in US regional banks and Europe, Credit Suisse, and what will be the implication to Asia. The second, the focus of today's panel discussion is about digital currency and CBDC. And this morning we had a lot of discussion. And in this area, I think a lot of participants want to know your view. So I will have a lot of questions to you. The third part of today's panel is about climate change and what central bank can do. And there is a lot of debate here. So here I also like to have your view. So you might explain the view of central banks, but if possible, we are very happy to hear your personal view, if that is possible. Okay, so let's start with the first topics about this banking program and stress which happen in US and Europe. My first question to two of you is, considering this recent banking stress in US and Europe, and then everybody know this was the program was there. It's mainly program come from management, but also we know this was program was created by Digital Bank Run. So this digital bank run, is this an issue also in your countries? Okay, let's start with Mr. Jones.
Good afternoon. Thank you.
Yes.
I think the first thing to say is that in Australia, we did not see a deposit flight either in the aggregate across the entirety of the banking system or even among certain cohorts of banks, as was observed internationally. I think there's good reasons for this. Recognizing that deposit runs are essentially about trust or a lack of trust. The system of bank regulation and supervision in Australia is designed to create the conditions where there's a very high degree of confidence in the health of the banking system. And one tangible way that finds expression is the banks here in Australia operate under a regulatory regime that is super equivalent to the Basel requirements. Now, all of that said, there's no sense of complacency here either. So although the Australian banking system was not directly affected, I think there's probably three key takeaways from the experience earlier this year for central banks in general. And the first is that in the digital era, deposit outflows can be larger and quicker than envisaged by the regulatory framework that was established after the global financial crisis. The potential velocity of deposit withdrawals is clearly higher in the digital age. Mm-hmm. Bank runs can now be conducted at the stroke of a keyboard. This has quite different implications from the old-fashioned bank runs that all of us grew up in, where you had to stand outside a bank in the rain and then bury the cash in your backyard. Mm-hmm. I think this has implications for the appropriate levels of liquidity buffers for banks. And unsurprisingly, then, it's an area of active review by policymakers globally, and the regulators in Australia are part of those global conversations. So that's the first thing. The second lesson is the failure of smaller banks can have systemic consequences, even if the banks that are directly affected are not systemic by themselves. We've just seen that stress can spread very, very rapidly, including to institutions or jurisdictions that were not directly affected by the initial shock. And I think that can be most problematic where you're talking about institutions that maybe had long-running vulnerabilities that then get crystallized during this period of contagion. And so recent events are prompting a rethink of what it actually means to be systemically important. I think the third learning, and I'll finish up here, the third learning is that deposit insurance schemes, as well as recovery and resolution frameworks, need to be reviewed and made fit for purpose. What we're observing now is international bodies and national regulators, including here in Australia, are considering a range of areas for improvement. On deposit insurance, a number of countries are looking at are looking at how to ensure that depositors can maintain their access to funds in banks that are going through some sort of resolution process. So it's not just about it's not just the security of your money, but it's having ongoing access to your money. That's the first thing. The second is some countries are looking again at deposit insurance limits and looking at a range of possible adjustments there. And then there's another set of issues relating to resolution frameworks. Countries now really want to make sure that bailing capital can in fact be bailed in during a crisis, that it is actually fit to do what we think it was designed to do. So they are, I think, some higher level lessons from the events earlier this year. Thank you.
Very good. Mr. Kenneth Guy, is my pronunciation correct?
Sure. Yeah, that's right.
Okay. Go ahead.
Yeah, thanks so much, Sayuri. Yeah, so actually Brad had shared a lot of the I would say salient points already. I would say for this question. Let me just add on some perspectives. I think so similar to Australia when it came to the recent banking sector stresses, we also in Singapore didn't really observe any type of like stress or deposit outflow behavior. I think, just as in Australia, Singapore's banks are well capitalized, and we conduct, regular stress tests, and they have healthy liquidity positions, which we closely monitor. And, similar to many central banks, we stand ready to provide liquidity if necessary. And I think this is something that market participants and depositors appreciate. So in terms of the implications, I think, Brad had already covered, this new era of digital banking, potential risks, for example, from new forms of information transmission as well, including social media. All of this has impact on the nature of deposit outflows. So MES, of course, we like other central banks, or rather MES being an integrated supervisor, as well, being both a supervisor as well as a central bank. On the supervisory side, we have been stepping up our efforts there to engage banks, to ensure that they have appropriate crisis management and contingency planning capabilities to deal with liquidity stress events. Similarly as well, on the resolution front, we are similarly reviewing, our resolution strategies and tools. We conduct ongoing reviews. So recently, MES had actually raised its deposit insurance coverage as well. This was actually ongoing review, not really in response per se to the recent banking stresses, but it goes to show how authorities around the world do actually conduct such ongoing reviews. And finally, on the lender of last resort front, we do also continue to review that we have a appropriate crisis ready framework. We check that we are able to carry out clear communications and have appropriate criteria for accessing liquidity facilities, and importantly also regular testing of these processes and facilities, because the actual process itself does make a difference, as the recent banking sector stresses had shown. So in addition to the points that Brad had raised, I will also highlight the importance of continuing to review and strengthen our surveillance capabilities, surveillance of financial sector fragilities. I think it's actually quite important, this exercise, or rather the recent banking stresses have shown that it's really quite important to go beyond the standard types of analyses of regulatory thresholds to look for vulnerabilities, and less obvious kind of tail risks. If you look at the recent episodes, the failed banks, weren't exactly, at the weakest end in terms of standard regulatory metrics, for example, such as capital adequacy and liquidity coverage ratios. However, if one were to drill further into some of the other metrics, some other metrics did actually appear concerning in retrospect. For example, concentration of uninsured deposits, the extent of uninsured leverage, and also more broadly, the profitability of the underlying business models and strategies of these banks. So I think this is something that at least on our end, we are of course taking steps to pay more attention to these, as well as part of our surveillance efforts. In addition to that, I would say that we do also need to consider other means as well of sharing of best practice information between central banks and authorities. I think this recent episode has shown that actually it illustrates again the interconnectedness of banking sector risk, and the similarity as well of the need for surveillance and cooperation. So on that front, MES has also been involved already for a couple of years now in some innovation efforts with the Innovation Hub for the Bank of International Settlements, the BIS. So over there, actually, we have carried out a couple of projects relating to what is called SUPTEC, Supervisory Technology. And one of these projects which I'm coordinating is called Project Ellipse. So Project Ellipse is actually a tool that is meant to be shared across different central banks and supervisors. And one of the functionalities of this tool is actually to carry out risk surveillance. So arising from the recent banking sector stresses, this tool has actually come in handy as a means of information sharing across different central banks and authorities, so that we can exchange best practices or ideas in terms of surveillance, so-called methodologies and liquidity risk monitoring.
So I think he's coming back. So with Brad, I think we'd like to know more about CBDC. So let's switch to the next topics. So about this CBDC, first question is I'd like to discuss with you about retail CBDC. So CBDC issued by central bank to retail investors. Now, a lot of reason why a lot of central banks pay attention to the retail CBDC is because of financial inclusion, especially in the emerging economy, and then for central bank to provide safe central bank currency. And how important the retail CBDC is in Australia.
We are keeping an open mind on the prospects for a retail CBDC, and we're continuing to do work in that space. But in the Australian context, almost all of our research is pointing to more compelling policy cases for digital money, including a CBDC, emerging in wholesale and cross-border applications rather than retail. And that assessment was reinforced in the course of a recent pilot project we ran in consultation with industry that just concluded very recently. So we've studied closely the arguments that have been put forward for introducing a retail CBDC internationally. And while we can see some merit in some countries pursuing that path, the same circumstances just aren't readily apparent in Australia. And the two main reasons for that are that, first of all, financial inclusion is not a first-order issue in Australia. And second of all, most importantly, we already have a modern, well-functioning retail payment system that enables payments to be made in real time, 24/7, with quite a rich set of supporting data. And at the same time, that we don't see a lot of upside, we do see some potentially significant issues that a retail CBDC could introduce in the form of disintermediating the banking system, amplifying the risk of bank runs and interfering with the transmission of monetary policy. None of these are insurmountable, but they need very careful consideration. I gave a speech about this a year ago. When we look at the cost-benefit analysis for a CBDC in wholesale or cross-border applications, there we see a rather different proposition. We can see potentially significant benefits, but with less scope to disrupt the financial system or the implementation of monetary policy. And a good example there would be the potential for tokenized forms of money, including potentially a wholesale CBDC, to promote tokenized asset markets, which could do a couple of things. It could increase liquidity and lower the cost of trading and the cost of capital in established markets, and at the same time promote the growth of completely new markets, for instance, in areas like renewable energy and biodiversity and carbon credits. It's still a bit of an open question as to which combination of public and private digital money and infrastructure you need to harness most of these sorts of benefits. My sense is that a wholesale CBDC could have an important role in complementing and enabling further innovation in private digital money, and also critically in enhancing the key features of the two-tier monetary system that have served us very well for a long period of time. And so it's for all of those reasons that we've got a very active research agenda underway in the area of a wholesale CBDC, more so than on the retail side.
Okay, thank you very much. So let's concentrate on retail CBDC at this stage. So Kenneth, how about in Singapore? How important the retail CBDC is? For example, in terms of financial inclusion or the central bank's obligation to provide safe the central bank monies. How is the Singapore's case?
The discussion earlier, but just purely on retail CBDC in the case of Singapore. MAS current assessment is that a retail CBDC in Singapore is not really that compelling. As yet noted, financial inclusion is not really a significant issue in Singapore. And we find that electronic payments are also quite pervasive, seamless, and efficient in Singapore. So in Singapore's case, what our approach is really to rely more on enhancements to existing infrastructure and regulations to achieve our objective of cheap and fast payments, for all.
Yes.
And this includes, existing forms of central bank backed money. So, recently MAS has, for example, opened up our real-time payments, retail payment system to new players. We've also awarded new digital bank licenses to spur competition and innovation in the payments market. We've also improved cross-border payments infrastructure by establishing linkages between national retail payment systems with like-minded central banks, such as in Malaysia and in Thailand. And also MAS is collaborating with the BIS Innovation Hub that I mentioned earlier on another project called Project Nexus. This is to develop a central hub, right, that allows for multilateral linkages between payment systems. So I do want to reiterate that it doesn't mean that MAS has ruled out introducing retail CBDC at some point, because we do keep an open mind as we recognize the possibility that innovations around CBDCs may emerge in future. And a case for such a CBDC could also strengthen if foreign digital currencies become widely used locally.
So a lot of countries, emerging economies or developed countries, we have this fast payment system. So current existing retail payment system is already quite efficient. So in that sense, there's no strong reason to bring in this retail CBDC. But what about this monetary policy perspectives? Academician talks a lot about this retail CBDC, and I think partly related to this possibility of imposing interest rate on this deposit, and probably case of negative interest rate. A case of like Japan, we have a negative interest rate. In your country, maybe you don't have a opportunity to have a negative interest rate. But in terms of impact on monetary policy, is real CBDC important? Okay, let's start with Kenneth.
Yeah, thanks. So I think in Singapore's case, as you many of you know, we operate foreign exchange-based monetary policy, not so much for interest rates. So the case of managing so-called or assisting with situations such as negative interest rates isn't so relevant. In the case of Singapore, what our innovation has really focused more around the concept of what we call purpose-bound money. So you can think of purpose-bound money, which is a type of bearer instrument which can be transferable, between peer-to-peer, and it can contain, certain conditions as pre-programmed conditions as part of, the money being released. So actually, what MES thinks is that we think that there are potential users for such purpose-bound money. For example, we think it can be used in use cases such as prepaid packages, online commerce, contractual agreements, trade finance, and also cross-border payments as well. So from our perspective, we think that actually we are focusing more on such areas in terms of retail. Yeah, thank you.
So this morning, one presenter talked about this purpose-bound money. He said this is stable coin. Is it?
Oh, well, it actually can take place in I think different formats. I think some of because what MES has been carrying out actually quite a few trials to test out this concept, and I think some of them may have involved at some point in the value chain some type of potential stablecoin, but the underlying concept actually isn't really a stablecoin, because there is, what is underlying is actually a digital Singapore dollar, not actually issued by a private entity. So, for example, at last year's Singapore FinTech Festival, there was actually, if any of you have visited, you may have actually seen that you may be able to test out this purpose-bound money, because one of Singapore's local banks, DBS, has actually tested out the use of this purpose-bound money to disperse, funds to individuals. In our case, it was a small use case. You could use it to buy food and beverage at the FinTech Festival, but it's just one illustration, if you will, of the so-called use case for purpose-bound money. But to your question, the underlying actually is not a stable coin. It really is a digital, Singapore dollar. Yeah.
I see. Okay, Brad, what do you think from academics' perspectives? Everybody talk about there is an impact of CBDC on the monetary policy implication. What is your view?
Yes, there's a few channels here that I think are worth considering. The first is that relates to the potential for a CBDC to become a retail CBDC to become the preferred source of liquidity holdings for households in normal times at the expense of commercial bank deposits. In that sort of a world, central banks could find themselves awash in household deposits they don't need and can't usefully invest. They'd give up effectively control over the size of their balance sheet in the process. All the while, commercial banks which do need deposits to finance their operations could have their funding and lending channels significantly affected, and so that could disrupt monetary policy transmission. So that would be one set of issues. Now, there's been some workarounds that have been proposed here. None of them are particularly straightforward. One workaround could be that banks might opt to compete harder for low-cost deposits on safety grounds by providing loans only to the very highest quality borrowers. Problem with that is it would disrupt credit supply in another way by starving otherwise creditworthy borrowers of access to funding. Some researchers have also suggested a CBDC would have little effect on bank funding and lending if central banks extended to banks plentiful cheap loans as compensation for the loss of household deposits. The problem, of course, with that is we would find ourselves in a world where the commercial banking system was largely directly funded by a central bank, and that would overturn centuries-long practice and raise a whole litany of other issues. And then there's the question of the interest rate. So most central banks, and certainly it's the case in Australia, we've not really considered a retail CBDC in the context of being a monetary policy tool. We think of it more as a digital banknote that would complement physical cash rather than replacing it. And that would translate to elastically supplying a retail CBDC that, just like physical cash, pays the holder no interest. Now, there is an argument that what if you set the remuneration rate on a retail CBDC at a rate that was below the policy rate, particularly in a world where the policy rate was at the zero effective lower bound. But to be fully effective, that would necessitate phasing out banknotes. Because the higher return on physical cash, that is zero, would prompt some substitution out of CBDC and back into physical cash. And a number of major central banks, the Reserve Bank of Australia included, have committed to making banknotes available to the public for the foreseeable future. So for all of those reasons, I can't get too animated about the potential for a retail CBDC to be helpful from a monetary policy implementation perspective. And I can see some states of the world, particularly in a world where households lose confidence in banks and so run out of bank deposits into a CBDC, where it may actually be unhelpful because you could have bank deposits converted into CBDC at the stroke of a keyboard. And that could be potentially very destabilizing. And for that reason, the central banks that are contemplating introducing a retail CBDC, certainly those in the advanced economies, are talking about imposing very low caps on how much can be held, which to my way of thinking almost sort of defeats the purpose of introducing it in the first place.
So assuming that your central bank adopt retail CBDC, but as long as cash is there, I mean, usually central bank cannot say we will abolish cash. That is very difficult in a democratic society. So as long as cash is there, there is always substitution. So it's not going to be that effective. Am I right, Brad Jones?
Potentially, but it depends on a range of things, including whether the CBDC is remunerated or not. And it also depends on household and firm preferences, particularly household preferences for how they want to make their payments. They may be perfectly comfortable making digital payments in digital private money. That's been the lived experience here in Australia for a number of years, where we see the use of physical cash declining and the use of electronic transfers in private digital money increasing. I do just want to reiterate that while we don't see a compelling case in Australia for a retail CBDC at this point in time, may change, but at this point in time, the case for a wholesale CBDC is potentially a fair bit more promising because the benefits could be larger and the challenges could be more manageable than a retail CBDC. So that is why the bank is intensifying and stepping up its research agenda into wholesale CBDC.
Yes. Okay, Kenny's guy. So cash. So usually central bank is going to have both cash and retail CBDC. How about this perspective? Cash, there's anonymity, right? But CBDC, it's traceable. So therefore, even if suppose you introduce it, but maybe public prefer using cash. What do you think?
Yeah, so I guess the following is more of my own personal thoughts and readings, but because in Singapore's case, we're not really at that stage. But there are different means, I think, to preserve anonymity. For example, in some of the CBDCs being proposed globally, I think there's some idea that transactions below a certain amount, may not be subject to a stringent type of information reporting. So that potentially could help to assuage some of the concerns of those who use digital cash, particularly in those jurisdictions where the users do value that privacy, the use of that as well. Yeah.
I see. Okay. I have another question now to Brad. So I think you also mentioned a lot of central bank when they think about this CBDC, retail CBDC, usually central bank talk about two-tier system. But direct issuance of CBDC by central bank to retail people is more ideal, right? In terms of helicopter drop, fiscal policy or monetary policy, it's more efficient. But the only reason central bank is having this two-tier system is kind of support financial system. Today, one discussant this morning said, if there is a two-tier system, the impact will be not so big. So what is your view, Brad?
Well, it would be up to each central bank to determine if they wanted to issue a retail CBDC, how that practically took effect. What I would say, though, is the features of the two-tier monetary system are really important. And so they've served us very well. And so when we think about all the different permutations that our future monetary arrangements might take, my sense is that preserving and uplifting the features of that two-tier financial system is going to be paramount. And just think about the role of the central bank in that system. The role of the central bank is, first of all, to provide an anchor, foundational level of trust in the value of money, trust in the finality of settlement, and trust in the stability of the wider financial system. In addition, it can be a catalyst for innovation by providing this stable foundation of public money and public infrastructure on which private money and private monetary services can then build, innovate, and flourish in order to best meet the changing preferences and demands of households and businesses. Then we really get the best of both worlds. And so when I think about what the future of money looks like, what I have in mind is an enhanced version of the two-tier monetary system that has served us very well, just made fit for purpose in the digital era.
I see. How about you, Kenneth?
Yeah, so I think my views are quite similar to Brad's. What I would add is that the so-called existing systems, the two-tier system, has served well and has already also precipitated a lot of innovation, which I touched on already, some parts of it in my earlier remarks. So I think from from different viewpoints, but to your question, if it's talking about for example meeting the needs of the financial system, I think already existing so-called money, forms of digital money, which are private in nature, and various innovations on top of that have already done a lot, I would say, to improve key outcomes for participants in the financial system, whether it's retail or corporate players. So the idea there is really, what is this delta in my mind that this a CBDC can bring about. And in fact, again, just a personal observation, if you see the take-up of CBDCs, amongst the those who have pushed quite far on it, I think that there is still a challenge in so-called in having a higher kind of like take-up, because people are quite used to whatever forms of, or the most convenient or the most fit for purpose, they will gravitate towards that form of payment. So whatever new forms of money that we come up with as well will have to meet that benchmark as well.
By the way, audience, please ask question using chat system. Okay. So final question about this CBDC. Maybe start with Kenneth. So you mentioned about this cross-border retail payment, right? But there is also issue cross-border wholesale payment, right, among professional financial institutions. I mean, which is more promising and which is more important?
Yep. So MES, I think similar to Australia, also believes that wholesale is really the area of focus as well. So MES has actually been carrying out so-called innovation and pilot projects for several years actually on the wholesale CBDC front. We started off many years ago with several years ago with this project called Project Ubin, and since then we've kept iterating on that and building different variations of the use cases. So definitely it's on the we see more promise on the wholesale CBDC front for reasons I think that Brad also mentioned earlier as well.
How about Brad? This cross borders, there's a retail and wholesale way, right? What is your view?
Again, circumstances will differ for different countries, and I recognise that the sorts of issues that many emerging market economies face are quite different from some of those in advanced economies. But from our side, again, the more compelling use case for a CBDC would be in wholesale cross-border transactions, and we're actively engaged in dialogue and projects with partners around the world to better explore what sort of form and shape that may take. There are other alternatives, of course, which include linking up fast retail payment systems across borders. Kenneth mentioned a couple of initiatives that Singapore have embarked upon. There's a project across ASEAN that the bank is monitoring very closely, looking at doing something similar. So we shouldn't just assume that a retail CBDC is the only solution to that problem.
Very good. There's one question from floor. About CBDC, there's a similar question in second topics in today's conference about climate change, green and sustainable finance. Is there any way that CBDC can probably benefit the sustainable and green finance market in your country? Okay, let's start with Brad.
I think there can be. In fact, our recent pilot project looked at particular use cases where a CBDC was used to achieve atomic settlement in tokenized green assets or nature-based assets, biodiversity and carbon credits, for instance. But again, this is using a CBDC in a wholesale context to improve and uplift the speed and the resilience of settlement. So yes, I think there is one of the more compelling arguments for looking into a wholesale CBDC. Well, one of them is that it could help lower the cost of transaction and the cost of capital in established markets. But then separate to that, it could potentially help in the development of completely new markets in tokenized exchange, where the underlying assets are, say, nature-based assets like biodiversity or carbon credits. That's an area that I think warrants very close investigation.
Singapore is really advanced, I think, in terms of tokenized carbon credit and so on. Anyway, Kenny, what is your view? Any relationship?
So similar. I echo Brad's views, and I would add also that even on the retail front as well, what I mentioned earlier about purpose-bound money, I can also, envisage cases that would link, some of the usage of the currency, with potentially sustainability-based outcomes, or making payments only, upon certain outcomes being met as well. So to the extent that digital currency or CBDC, can help to facilitate this type of outcome-based, transactions, which I think is quite aligned with sustainability outcomes, then that's something that would be helpful as well.
Good. Okay, there's another question. Let me read it. So there is a high chance that institutionally stronger economies might have the potential to implement sophisticated payment system and CBDC. However, the many developing countries in Asia and the Pacific are less institutionally developed. Despite the high level of cross-border integration in terms of trade and investment, many Asian developing economies might face challenges in implementing digital currency and digital payment system. How can policymakers address the challenges of implementing CBDC and digital payment system in developing Asian economy with varying institutional capabilities, ensuring inclusive capital creation and trade integration? This is maybe for emerging economies, and probably somewhat different from your countries, but if you have some view, would you like to reply to this question? Okay, Kenneth?
Thanks for that question. I think I missed some parts of the earlier discussion, but I think there was some mention about how I think in this conference as well, some talk about how developing countries do have that ability to actually leapfrog existing so-called frameworks, payments frameworks and networks. I think one key challenge, something that I mentioned earlier, one key challenge in changing so-called behavior in payments systems is that for developed countries, actually, there are a lot of entrenched payment systems in place already with incentive structures that are set up to actually continue such payments behavior. I think one benefit that developing countries do have is that there is a potential to actually shape that, in a bigger fashion. I mean, many developing countries from Africa to India have actually seen a lot of progress actually starting from, what could be a point that is less developed, but able to improve, I would say, payments outcomes for their respective countries. But as you had mentioned, this is something that I would say is a different consideration versus a developed country. Thanks.
Good. Brad?
Well, I mean, it's really up to every country to, set their policies that are most appropriate given the unique circumstances. I will just make one general point, which is that if given the choice between investing in a completely greenfield area, really, which is retail CBDC, there's only a very small number of countries that have pushed into that space, compared to, say, developing a strong and resilient fast payment system at the retail level. There's in a world of finite resources and finite capacity, my high-level suggestion would be focus on the fundamentals, get the fundamentals right. There's plenty of knowledge in the region about how to build a strong, resilient, and efficient, fast retail payment system. I think there's much less evidence that could be drawn on in the case of building a retail CBDC capability. So some countries may just find it, if given the two choices, that there's more bang for your buck getting a fast retail a payment system up and running, drawing on the lessons of many neighbouring countries compared to a retail CBDC.
Very good. Okay, so let's move to the final theme. It's about climate change. So among central bankers, there's two ways to deal with climate change. So one is using monetary policy. Then the other one is to deal with this climate change, climate-related financial risk, more like prudential policies. Let's start with green monetary policy. There is a big debate among central banks. There's a central bank such as Bank of England, ECB. They are very environmentally conscious, and then they, try to use green criteria when they do corporate bond purchases. But there are some central banks which have a reservation about such kind of behavior, because after all, central bank's monetary policy is counter-cyclical monetary policy. So, when they have to tighten monetary policy, so they have to sell all those assets and so on. So my first question to Brad Jones, what is your central bank or your view about use of monetary policy to promote green activities?
Different central banks approach that issue differently based on a range of factors. The most important of which connects to what is in their mandate. The operational independence of central banks that central banks enjoy does not give them an unfettered ability to pursue objectives for which they do not have a public mandate. Now, that said, central banks would also be abrogating their responsibility in not investing resources to better understand how a changing climate could impact their ability to achieve their mandated objectives. Climate change and the transition to a low emissions world is clearly going to have wide-ranging implications on the macroeconomy and on the financial system. And those implications are relevant for the setting of monetary policy and could potentially be relevant from a financial stability perspective as well.
Yes.
And the recent review conducted into the bank's monetary policy framework also made this point clear, that that we need to be continuing to invest in our understanding of how the economy and financial system could be affected by climate change and the transition to a low emissions world.
Yes. I think it also depends on the what monetary policy each central bank is doing, right? So if the central bank is doing like credit extension program, they can apply green criteria. That is what Bank of Japan is doing, and PBOC is doing, and also whether the country is doing corporate bond purchases and so on. So anyway, so Kenneth, in the case of Singapore, I know you try to have an emission target on your foreign reserve, because your monetary policy is a bit different, right? In a small open economy, you need to focus on the exchange rate system, so peso appreciation. So you need to intervene in a foreign exchange market that is internationally accepted. So your central bank is very environmentally oriented. So your central bank set up this emission target. So can you explain your views?
Yeah, so I think on that emissions so-called framework that you mentioned, that is really more a reserve management, I would say, consideration, as opposed to say central bank so-called like operations per se, or something that's in relation to a specific program like those that you mentioned that central banks would carry out. I mean, my own personal take on this is that we should actually track quite carefully, when using monetary policy to pursue climate goals. Many central banks, of course, we may have slightly different objectives, but a lot of us do, focus on securing price and financial stability. And ultimately, this must hinge on low and stable inflation. So when it comes to, the impact of, sustainability, we should be attuned to the fact that, for example, repricing, for instance, of carbon-intensive energy sources, right, to reflect climate externalities, this could actually potentially diminish potential output and could actually put sustained upward pressure on inflation, for example. So I think, Brett's earlier point on, improving, continuing to improve our analytical, our forecasting and modeling frameworks do need to, progressively take into account these climate-related changes more explicitly. And another area, of course, is also those pertaining to, say, carbon taxes as well.
Yeah. So in the case of this foreign reserve management, usually, central bank, maintain some foreign reserve, and the most important priority is liquidity and safety, right? Safe asset. So that kind of factors sort of prioritize. Can I say that compares to climate factors?
Right.
Am I right? Okay.
Yes.
Yeah.
Yes.
So in that sense, I think it's very difficult to make green criteria into like monetary policy. They can do it, but under certain conditions.
Yeah, that's right. So like what you had mentioned earlier, ours is really, in Singapore's case, is really just looking at the segment of Singapore's foreign reserves that's managed by MES, and specifically in one particular asset class, which is equities, as a start. So I think it's really, my own personal view again is that I think it's really more of a initial step to send hopefully a clear signal, that we are actually incorporating it, into our processes, and we're prepared to make a commitment on that front. And after that, like what you had mentioned, as to whether, as you had mentioned, ultimately the goal, the key objective is of central banks, at least those in MES or other central banks, is for liquidity purposes. Not the primary objective wouldn't be one of climate related. Yeah.
Yes. So Brad, so I guess there is no objection among central bank with regards to the need for central bank to deepen understanding about climate-related financial risk, and then possibly do some kind of prudential approach. So I think at this moment, many central bank is doing climate scenario analysis for financial institution under their jurisdiction. What is Australians, the Reserve Bank of Australia's view on this? Is there anything additional the central bank can do?
So we're doing 5 things in this respect, actually. The first, as I mentioned earlier, is we are increasing the resources we devote to better understanding how structural change and more frequent supply shocks on the economy could occur from a changing climate and the transition path, what that could mean for growth, for labour markets and for inflation. So that's the first thing. The second thing is we are examining the physical and transition risks for financial stability. That's where scenario tests, scenario analysis and stress testing frameworks come into the picture, and we're developing those in consultation with other regulators in Australia. We're part of international groups that are helping develop these scenarios and metrics, and we speak a lot to financial institutions to better understand how they're doing this. The third thing is monitoring climate-related trends in financial markets. So that includes exploring developments in green and sustainable finance markets and examining how climate risks are being priced into assets. And then a fourth initiative, if you like, is contributing to climate-related financial policy and regulation. So there we're supporting the Australian government in the implementation of standardised, internationally aligned climate-related financial disclosure requirements for large businesses and for financial institutions. And we're also helping to oversee the development of an Australian sustainable finance taxonomy and strategies to prevent greenwashing. And the last thing we're doing is spending time understanding both the risks and opportunities that are climate-related for our own operations. We're keeping a close eye on how other central banks are incorporating climate-related considerations into their operations, including for reserves management. Like, as Kenneth set out for the MAS, if green or sustainable bonds meet our standard investment criteria for FX reserves, in theory, we could purchase them, but climate-related considerations are not currently an explicit or standalone objective. And the final thing the bank is doing in this fifth respect is, in line with the Australian Public Service net zero requirements, the bank has set a target to reduce its Scope 1 and Scope 2 emissions to net zero by 2030. And we're considering what sort of sustainability and climate-related financial disclosures we can make in addition to the operational emissions reporting that we've done in our last annual report.
Thank you. Kenneth?
Yeah, I think so similar to what Brett said. MES is actually involved in quite a few initiatives, I think, on this front. Being a regulator as well, what we view that one key role we play is to promote the adoption of sound environment risk management practices amongst the industry. So back in 2020, MES had actually issued guidelines on environment risk management for banks, insurers, as well as asset managers. So across a consistent set of expectations, across different financial institutions. So the goal there really is having effective governance and strategy in the first instance, robust risk management and clear and relevant disclosure. So on top of that as well, MES is looking to build industry capabilities in climate risk assessments as well. We are incorporating a range of long-term climate scenarios as part of our stress tests for the financial industry this year by taking reference to scenarios from the Network for Greening of Financial System, the NGFS, as well as feedback from other stakeholders. So we think that these climate stress tests will be a helpful opportunity to learn, not only for for everyone, for the financial institutions, for ourselves as well. So, and we will also be looking to enhance our own scenario analysis and modeling capabilities, for better policy making and outcomes. Yeah.
Very good. Thank you very much. Let me summarize quickly about what we discussed. So as for this banking program, digital run, so you have to be prepared for that. But at this moment, the two countries, Australia, Singapore, well-trusted, well-capitalized banking system, they didn't have any contagion problems. But I guess in the future at the Basel, maybe people will start to talk about what other measures may be necessary. The second point about CBDC, so retail CBDC may not be so comparing reason to have it anytime soon, because there is already faster payment, efficient retail payment system. Maybe we can probably wholesale cross-border payment can be more promising. The final point about the central bank's role in climate change. So monetary policy is a bit challenging, and there is a important mandate. So at this stage, it's not really clear whether it's consistent with this introducing green idea to the monetary policy. But in terms of prudential policy to promote awareness of climate risk among financial institutions, and climate stress test is very important. And then there is, I think, a consensus here. Okay, thank you very much, Kenny and Brad, and I really enjoyed talking with you, and I learned a lot. Thank you. So this is the end of our panel session. Thank you very much.
Thank you, everyone.
Thank you. So now we move to the final remark from John.
Thank you, Professor Shirai. I will just say a few words and then I will hand back to you. So we've come to the end of this event. I think we have learned a lot in terms of the challenges that central banks face in the current environment. And these, of course, have amplified in recent years, given the developments with climate and ongoing volatility in terms of banking sector spillovers, as well as enhanced spillovers related to digital finance. I think that to a certain extent, developments with digital finance have perhaps accelerated shifts in central banks towards central bank digital currencies. And I think we learned a lot today about how emerging markets are, pursuing this type of mechanism in a different manner to advanced economies, with emerging markets more interested perhaps in the financial inclusion aspect, with advanced economies perhaps more interested in efficiency of payments and more regulatory types of concerns. On top of that, I think the issue of climate change is very important for central banks. As we know, in recent years, the issue of climate risk is being looked at closely by central banks. The NGFS is behind a lot of the work that central banks are currently doing in this sphere. Many central banks are integrating climate risks into their monetary policy operational framework. And we heard in the panel just now that issues around green monetary policy are, dependent on the type of mandates that the central bank will follow. This, of course, is very, very true. And, issues around market neutrality are also behind objectives towards green monetary policy. So I think that this is an evolving issue that central banks will, need to really look at closely in coming years. I think that if we take a step back and look at how central banks, are really effective, it's really through the issue of credibility and communication. And I think that maintaining credibility in the mandate will be key, whether we go down the route of CBDC or whether we go down the route of green monetary policy. It will be necessary to maintain that effective communication through credibility in whatever the mandate is. So I'll stop here and just say thank you to all of the speakers today. And I think we have, enriched our knowledge in terms of where the gaps are going ahead. So I'll stop here and I'll hand back to Professor Shirai to give some final words.
Okay. So I thought today's conference was very successful, and I was very impressed by all speakers and panelists. And, we had a lot of honest discussion. And then it was interesting for me to find out this retail CBDC, issue is not really may not be so compelling because there is already fast payment system. Maybe wholesale CBDC can be more promising. I think it depends on countries. So emerging economies may be different view. About climate change, like John said, there's a lot of discussion among central bank, and NGFS is proposing, this green monetary policy. I personally agree, but probably I think there's some objection from some central bank about green monetary policies, perhaps because we don't really understand yet about the linkage between this climate change and macro data. But in the future, I think we might have a time to discuss about this issue more deeply. So at this moment, maybe still premature, but that doesn't mean green monetary policy should be it's not it should be ignored at this moment. Yeah. So thank you very much, everybody, and thank you for participating in this conference.